program Income Tax Series 2.0. It's a session 3 of this program, and we have our distinguished speaker CS SASHANK SRIVATSAN sir with us. Welcome, sir. Before we begin the session, I'd like the members to stand up for the ICA motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. So, before we begin, I would like to have a short summary of Srivatsan sir. CS SASHANK is a chartered accountant in practice for the past 6 years with extensive experience in taxation, audit, and assurance engagement. His expertise spans a wide range of domains, including accounting standards, financial reporting of entities, bank audits, and direct taxation. He has actively contributed as a co-opted member of the Accountant Standards Board and Expert Advisory Committee of ICAI. Notably, he was also a part of ICAI task force that collaborated with Ministry of Finance, the Central Board of Direct Taxes, and Infosys to resolve issues relating to income tax e-filing portal. Beyond his professional work, he has also contributed significantly to knowledge sharing, assisting with several publications, and also a sought-after speaker at ICAI. On behalf of SAIC of ICAI, sir, thank you for accepting our invite and taking the time to be with us today. As a token of appreciation, I would like to invite CA Mahesh sir to kindly present the memento to CA SASHANK SRIVATSAN sir as a gesture of gratitude and respect. Thank you, sir. We are looking forward to have a productive and inspiring session with you, sir.
So very good morning to all of you. So before starting my speech, I just wanted to tell one thing. I don't know what times we are right now. We are in the time of war or not war. So before starting today's speech, I just wanted to salute our armed forces and our brothers and sisters in the border who are keeping us safe, keeping us healthy, and doing all good things for us. So this is one thing I just wanted to give a tribute to the Indian Army, Navy, as well as the Air Force, who are doing a tremendous job in securing our borders and keeping us safe. Though we are in the south, we don't know what impact is there. We should also pray to our brothers and sisters in the north who are going to face a very, very, very tough time during the next 15 days. So I just wanted to start my speech just by thanking God for the Indian Army, and thanking us to be very safe. So on that note, we will just start with our, before the topic is actually just financial statement for non-corporate entities. But before going to that, I just wanted to signify what is the most important thing in for non-corporate entities. They all have to follow accounting standards. So when I was there in the part of Accounting Standards Board, the main important thing what we all discussed is the need for following accounting standards for non-corporate entities. So all the accounting standards, to be very honest, as auditors, accounting standards are being followed in the preparation of financial statements. The only mistake where we do is, we do not do proper documentation of how we follow the accounting standards. We actually follow accounting standards, but we do not document it properly. I will just give one example. In income tax law, there is a section 36, subsection 1, clause 3. What does that section say? What does that section say? Any interest on borrowing cost before the asset is put to use, what do? We cannot allow it. Only after the asset is put to use, we allow it as an expense. So what do? We need to capitalize it. In accounting standards, a very similar topic is there, AS 16, borrowing cost, which says the same thing in a different way, where till the asset is ready to use. Because in accounting standards, the word we use is ready to use. In income tax law, we use the word put to use. There is a slight difference between them, but more or less we are following it. So we are disallowing it there. Suppose it's at arm's length price. It's not at arm's length price. AS 18 applies. The same thing in our tax audit report in clause 23. We show it as a 48(2)(b disallowance. If it is excessive or unreasonable, we do quote it in our clause 23 of our tax audit report. So like this, inventory, lower of cost or goods, lower of cost or net realizable value, whichever is lower, said in income tax law, same thing is followed in accounting standards too. So more or less we follow, but the documentation isn't there. Why following accounting standards for non-corporate entities is the need of the hour? I will just say, what is the role of auditors in compliance with accounting standards? What does our code of ethics says? And composition of business and necessities in India. I'm just going to give a very brief overview. Then level 1, level 2, level 3 and level 4 non-corporate entities. What are level 1 entities? What are level 2 entities? What are level 3 and what are level 4 non-corporate entities? Why? Because non-corporate entities have been categorized in this category so that some accounting standards are applicable to all the level 1, level 2, level 3 entities. There are some exceptions given to level 2, level 3 and level 4 entities. So there are relaxations and exemptions given for the smaller size non-corporate entities, because more compliance you put, it would become a bigger problem. So this is what is given. Also I will be covering charitable trust. So charitable trust, not-for-profit organizations, there is a separate guidance, but it is also there in accounting standards. They also have to comply with accounting standards and any other additional requirement what we need to show in our documentation or your financial statements as your notes. So that I will classify, and then I will show you the financial statements. Also I will cover a little bit of cash basis of accounting. So accounting standards for cash basis of accounting, they have given a technical guide. Accounting Standards Board, I was part of that particular publication. There is a technical guide on cash basis of accounting, because why that is the need of the hour is, most of the trust after the recent amendments, we do not follow mercantile system. Why? Because application of money is considered as application only if the amount is paid. So if it is paid, so that is the reason why we have changed a lot of clients from mercantile basis to cash basis, because it makes more sense. If I put a provision and I cannot claim the expense or I cannot claim the application, it does not make any particular sense. So this is what we are going to cover. I will show you how to take the financial statement. I will show even a practical way how to show the prepare the financial statements. It's a very easy way. So the next thing what we are going to do is, what is the role of auditors in compliance with accounting standards? First we need to remember, as auditors, our role is not to prepare the financial statements. The financial statements preparation is the duty of the client. Our job is to only express an opinion on the financial statements. So accounting standards need to be followed by the person who is preparing financial statements. Then you can ask me, Sashank, if they have to follow, how it is going to be my problem? Why it is going to be my problem is, I am actually telling For non-corporate entities, where is then audit engagement there? In our tax audit. Tax audit report is the only place we do audit for non-corporate entities. Form 3CB is there. Non-corporate entities, we prepare Form 3CB and Form 3CD. Also one more thing, Form 3CD is the duty of the client to prepare again. Form 3CB only I will give my opinion. So it is form again, even though we upload Form 3CA 3CD or Form 3CB 3CD, the duty of the auditor is only to give an opinion in Form 3CB. 3CD is again management's responsibility. This diversion, this segregation of work should be clearly communicated to the client. The client is more responsible for the financial statement that he has prepared than the auditor. So any financial statement, ensure clients must sign the financial statements either physically or digitally. So when we upload the financial statement along with my tax audit report, kindly ensure either it is signed physically or at least a digital signature has been enclosed. Please ensure that that particular thing is done. If it is not done, if we put SD, client will tell, sir, I have no connection with this. Because today you know the legal framework, a lot of issues are there, disciplinary proceedings. I will show where all disciplinary proceedings happen if we do not follow financial statements for non-corporate, we do not follow accounting standards for non-corporate entities. So the legal requirements is, some legal requirements is given to follow accounting standards, Companies Act, IRDA Act. So there itself they give the responsibility. Auditor's responsibility is give the opinion on the financial statements. So ICI Code of Ethics, 3 important clauses in the second schedule. Second schedule gives severe punishment. So it has a higher punishment than the first schedule. What are the main things in the second schedule is, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he fails to disclose a material fact known to him which is not disclosed in the financial statement, but disclosure of which is necessary in making such financial statement where he is concerned with the financial statement in a professional capacity. So what does that mean? If I know a material fact and I have not disclosed that material fact, then I would be liable in the disciplinary proceedings because I have to follow. So not following accounting standards is a material misstatement. So SA 315, SA 320 standards on auditing is very clear. This accounting standards on non-corporate entities must be followed. Forget about that. Today all firms need to be peer reviewed. All peer review documentation or tax audit quality review board or audit quality review board, you take the report. What is the major lacking thing of all the auditors is SA 230 documentation. There is no proper documentation that accounting standards is followed or standards on auditing is followed. So for that you need to take a checklist. There is a checklist, I have a checklist. Also the institute has given a particular checklist. Just put compliance with all the accounting standards and the standards on auditing. So all these classifications need to be done. So clause 5 you are guilty. Clause 6 also you are guilty if you fail to report a material misstatement to him known to appear in a financial statement which is concerned in the professional capacity. So again, as an auditor you express an opinion and you do not follow accounting standards, 5 and 6. So 5 is material fact known to him, 6 is material misstatement. So material fact here, say AS18 you know related parties but you have not disclosed it in your financial statement. That is a material fact known to the auditor. So he should report it in the financial statements. So the financial statements is not only the balance sheet, P&L and the schedule notes. Also the accounting standards compliance note should be forming part of your financial statement. So you have to write your accounting policy. That is required as per accounting standards 1. Accounting standards 1 tell what all are the policies you follow for accounting standards. So this is very necessary. The next clause, also you are guilty of professional misconduct, because I am not telling this, there have been a lot of cases in the disciplinary committee with this particular issues. The third thing is, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he does not exercise due diligence or is grossly negligent in the conduct of his professional duties. So while expressing an opinion on the financial statement, it is the duty of the auditor to ensure compliance with accounting standards as prescribed by ICAI. If the same has not been complied, it is deemed that auditor has not exercised his due diligence. So you have to apply your due diligence. So 3 clauses: material fact known to him and he has not disclosed. Second is material misstatement there in financial, he has not reported. Third, due diligence. So if you have not followed accounting standards, all the 3 clauses you are guilty of professional misconduct. So this, as auditors, we should be very careful. Those are financial reporting preparers, those who are come from the non-corporate entities. If you are a chartered accountant, you also have to follow the accounting standards, because it's management's responsibility. Plus material misstatement, if you have not applied due diligence, you are again guilty of professional misconduct. This is all for people in practice, but even non-practice in the ICAI disciplinary proceedings, you have to follow accounting standards. So accounting standards are applicable for under Companies Act for all the companies. This is just for companies. So section 133 Companies Act says this, but we are going to look for non-corporate entities. So a quick brief: how many non-corporate entities are there? This is my this table isn't there in the recent past. This table was there when the income tax portal was not working that well, or that so assessment year 21-22 during COVID, they were telling that returns need to be filed, What I am just trying to see is comparison. So this is assessment year 19-20. Total tax audit report filed is around 28 lakhs. If you see 3CA, 3CD, 2,88,000 non-corporate entities have filed. Non-corporate entities is almost 25 lakhs. So 90% of your tax audit cases are non-corporate entities. So no matter what, the backbone of the economy is non-corporate entity. Each year you can see, even in the recent past, even after the amendment, it is around 70 to 80%. There is no statistic released, but it will not change drastically. Even in this, suppose I am audited under Societies Act or some other act, and I am an association of person, I will come in form 3CA instead of form 3CB. So in fact, the number may be even more. Why I am just telling you, usually form 3CA will be there only for company, because 3CA is applicable for entities where another audit has taken place. Non-corporate entities, no other audit apart from income tax audit. So why it is a must for accounting standards and financial statement comparison is, you are also expressing an opinion in form 3CB. What you are expressing an opinion is, the balance sheet and the P&L are true and correct, and both you are telling true and correct, particulars in the tax audit report as well as balance sheet and P&L. But the guidance note is very clear. Even though the word is used true and correct in form 3CB, the word you have to understand is true and fair, because we cannot be 100% correct. In a place where there are a lot of estimation involved, 100% accuracy is not possible. So only a reasonable assurance is required. Absolute assurance is not required. So this is what is the criteria given. So the next one, accounting standards applicability for tax audit. So there is a council decision. Accounting standards shall apply unilaterally. When it is told in 1994. January 1994 itself, very clear that accounting standards is applicable for tax audit cases. So this is a mandatory documentation. This document, this came in CA journal. So the chartered accountant is a CA journal in January 94 edition. There is a clarification. It is in fact older than me and it is still need to be followed till date. So this, there is no change. But today we are all looking at it. Today we are all seeing non-corporate entities. Why? Because they have given a guidance note to follow for non-corporate entities also for the financial statements. But this is there for a very, very long time. So what are the non-corporate assessees? I've just given the definition from Income Tax Act. Even in the guidance note it is very clear, the same more or less. Individual, HUF, AOP, local authority, body of individuals, and then you have your association of person and artificial juridical person. So if they are not coming in the above categories, all these are non-corporate. So SASHANK, is LLP a corporate or a non-corporate? That question is there. It is a body corporate as per Companies Act definition. That confusion is there, so a separate guidance note is given for LLPs. So even though in income tax LLPs come under firm, in Companies Act and LLP Act they come under the guise of body corporate. So if they are a body corporate, they are already considered as a corporate entity, but since there is a confusion, for LLPs financial statement there is a separate guidance note. So there is no confusion in that particular clause. So the next thing what we are going to, so types of corporate entities, non-corporate entities as per council decisions. So this is what is our ICI publication, again 1991 edition of Chartered Accountant. Sole proprietary concerns and individuals, partnership firms, societies registered under Societies Registration Act, trust, HUF and AOP. So all these are the categorization of the same. So these are all non-corporate entities, all of them must follow. So basically corporate entities also follow accounting standards, non-corporate entities also follow accounting standards. The biggest problem for us as auditors, so much complaints is there, how to do the work. I have to do a lot of tax audit. Client, if I follow accounting standards also, client may not give me additional fees for it. This is where we have to educate. This is accounting standards board has come out with the guidance note. Why they have come out with the guidance note is, with this guidance note at least we have to tell that we have to prepare financial statement as per accounting standards. It should be standardized format. I am doing more work than what is required, so I have to express an opinion. So all this is an exceptional more task. So kindly we have to educate our clients. Where our clients don't understand our value, we have to show the value. Not only one auditor should do, all the auditors put together as a society we do it, the client will understand our importance. Because as a community we have to show our importance. We cannot show individual basis. So we have to tell what are the additional works done as an auditor. So the next, this is the new classification of non-corporate entities. It is equivalent to the old MSME definition before this budget. So a lot of people ask, will there be a change? So far, no idea. I don't think there will be a change in the future, because for non-corporate entities they will keep this, which is more or less with the old MSME definition and not the new definition. So I'll just show a comparison between this and the old MSME definition. But this is what is applicable. This non-corporate entity size, level 1, level 2, level 3, level 4 is as per the old MSME definition, but that is the current categorization of non-corporate entities. So I repeat, this may be more or less similar to the old MSME definition, but that is what stands as level 1, level 2, level 3, level 4 for following accounting standards. That is what is the criteria. So level 1 entities. So level 1 is considered as large, level 2 is medium, level 3 is small, level 4 is micro. So earlier material consumed, they were matching, more or less they were matching MSME, but now there is a definition change in the budget. So after that, They have not changed in ICA. ICA has not changed because this itself is more or less enough for the compliance. So I will just give a quick comparison. So non-corporate entities which fall under one or more of the following categories. It can fall under any one of the categories. They are also applicable for, they will be considered as level 1. So first criteria is very rare. Debt, equity or debt securities are listed or in the process of listing within India or outside India. So very rarely non-corporate entities will come here. Where they can come, say a firm directly converts into a public limited company and does listing. It is possible. It is possible. I immediately convert a firm to a company and I immediately try to list that particular year. So that may come in this first categorization. The second one is banks, financial institutions or entities carrying on insurance business. So if you notice, nationalized banks, they do not have limited as such, but they come under Banking Companies Act. They are a body corporate, but still this definition is there. So banks, financial institution or entities carrying on insurance business. So to get any approval for a bank or an insurance company or a financial institution from RBI or IRDA, you need to be a corporate entity. You cannot be a non-corporate entity, but this is there just in case. The third one, these two are the most important ones. These two defined by old MSME Act. So I'm just going to read. All commercial, industrial and business reporting entities whose turnover exceeds. So this word, just pay attention, commercial, industrial and business reporting entities. I'm not going to use it now. I use it when I define my charitable entities. So charitable trust, where it does come, because the word commercial, industrial and business. So charitable trust may not come under that. So we will see what is there when we do it. Whose turnover exceeds 250 crores in the immediately preceding account year. So turnover does not include other income. So the word used is turnover, not gross receipts or full receipts. The word used is turnover. So turnover is what the business deals in, what services or goods the business deals in. So that is what is categorized as turnover. It does not include other income. Only operating income will be there. Non-operating income will not be there. So exceeds 250 crores. So if you remember the old MSME definition, it is 50 to 250 crores is considered as medium entity. So above 250 crores is large, level 1. The next one is all commercial, industrial and business reporting enterprises having borrowings including public deposits in excess of 50 crores at any time. So balance sheet date, it need not cross 50 crores. Say it crossed on first week of September. Still they have to be level 1. Say first week of May. Any time they cross, it would be considered as this. So why I am comparing this? This is more or less similar to your plant and machinery. 10 to 50 crores is your old medium definition. The same thing is there here. Above 50 crores is large. Then you have holding and subsidiary of any of these entities. So any non-corporate entity which is a subsidiary or holding of these entities, they also have to prepare their financial statements as per level 1 entity. Now we'll go to level 2. So level 2, as I said, 50 to 250. 50 crores to 250 crores turnover was the old medium definition. It was the old medium definition. Now the same definition is there for level 2. Level 3, 10 to 50 was your investment in plant and machinery. That is not used here. The word used here is borrowings. So more or less, so the concept is somewhere there where it matched with my MSME. So 10 to 50 crores as well as holding and subsidiary of all these entities. And the next one, level 3 entities. So level 3 entities are non-corporate entities which are not level 1 and level 2, but they form under 10 to 50. Turnover is between 10 to 50 and borrowings is between 1 to 10 crores. So borrowings are between 1 to 10 crores, holding and subsidiary of the same are level 3. Why there is a categorization of levels is exemption and relaxations are given for the same. So the next one is non-corporate entities which are not there in level 1, level 2, level 3 or level 4. So less than 10 crore turnover and less than 1 crore borrowings. So level 4 entities, there are a lot of exceptions. So these are there, the 4 type of entities. So I'll just show a table for it. Yeah. So this is the classification. So you can just make a note of the table if you want. So large entities greater than 250, that is greater than 50. This was with old MSME and this is with new old. So this was before the first there was MSME definition that matched with this. Then the later one matched with this. The new one doesn't match with any of this. Will ICI publish? Till it is published, we cannot speculate. Till it is published, we cannot speculate. So all these items are there. So last year I was part of Accounting Standards Board. They never tried to change it. So I don't think there would be a change. If there is a change, there would be a change. So this greater than 50, this greater than 250. So this is what is the categorizations. So the next thing what we are going to see, what are the number of accounting standards applicable for non-corporate entities. So level 1 entities, 27 out of 27. It is as good as a corporate entity. Because I am not telling, there are a lot of firms till date doing 1000 crore turnover. There are HUFs which are doing 1000 crore. So all these entities are also as big as a company. Why they don't corporatize is no need. To be very honest, there is no need. Until and unless bank is giving some loan and reducing interest rate by 0.5%, in India half the business entities will not change. Because in 1950s or 40s they would have been formed as a non-corporate entities. Till date they can keep it. There is no need to change it. So for level 1 entities, 27 entities come here. For level 2, 16 accounting standards are fully applicable. 16 are fully applicable, 7 not applicable. So 7 accounting standards directly dropped for your medium entities. What are medium entities? Turnover between 50 to 250 crores, borrowing between 10 to 50 crores. So that 7 accounting standards are dropped, applicable with exemptions, 1 in AS 15, and applicable with disclosure exemption, there are 3. Level 3 entities. What are there for level 3 entities is 12 accounting standards are applicable. 9 are not applicable. So 2 more accounting standards are dropped. Relaxation is there in AS 15. Applicable with disclosure exemption, there are 5 disclosure exemptions. Level 4 entities, 8 accounting standards fully applicable. AS 22 is partially applicable. What is AS 22 is taxes on. It's a concept called as deferred tax asset and deferred tax liability. It is applicable for your level 2 and level 3. For your level 4 it is not applicable. So what is level 3? 10 to 50 crores of turnover, 1 to 10 crores of borrowing. This is up to 10 crores and up to 1 crore of 10 crores of turnover and 1 crore of borrowing. So 11 accounting standards are not applicable. Only 8 is fully applicable. Disclosure exemption there are 6 and 11 are totally not applicable. So these are the standards. So totally there are, SASHANK, there are 29 accounting standards. What happened? AS6 8 are not there. AS6 has been merged with AS, and AS8 more or less is covered in AS26, intangible assets. So what are the accounting standards? So a quick recap, just a small recap of what are the accounting standards there. So there are 27 accounting standards. What are the standards? First one is disclosure of accounting policies. Second one is valuation of inventories. Third one is cash flow statement. Cash flow statement needs to be prepared for your level 1 entity. So it is a must to give an opinion on financial statement. Tax audit report, should I upload with it? I don't know. But for your peer review file and expressing an opinion, cash flow statement is a must for your what? Entity. So an additional what we have to do. So where we are not doing compliances. So cash flow statement we are not doing for non-corporate entities. Kindly ensure this is being prepared for non-corporate entities. Then contingencies and events occurring after balance sheet. More or less we are following. So disclosure of accounting policies, basically just 3 fundamental accounting assumptions. Going concern, consistency and accrual. Are we following all 3? Yes. We are following all the 3 fundamental accounting assumptions. Why? Because if going concern is in there, we have to do realizable value accounting. Historical cost method of accounting. Accrual only most of the time it is followed. If accrual is not followed, cash system can be followed. But we should give a disclosure in the notes. Cash basis of accounting, we should give a disclosure AS1 notes. So I will show in cash basis of accounting what is the disclosure needed for cash basis of accounting. Third one, also one more important thing in AS1 is you have to disclose all the accounting standards are followed. So all these standards are followed, we have to give a notes in disclosure. So for corporate entities this is being done. The same thing should be done for non-corporate entities. So if your corporate entities are preparing, you just share the file, the accounting policies with your non-corporate entities and ensure that there are changes which are necessary to match with the accounting policy. So this is the major need. So the major need. So inventory, we follow valuation of inventory. So inventory we do either fee inventory valuation. Bill of value, whichever is lower, the same is taken. So the same is taken. So this is what we do for non-corporate entities also. Even in our ICDS, the same disclosure is there. There is only one difference. Also I will tell. In our accounting policy, generally in our inventory, in AS2, we need not add our refundable taxes. So any item with GST ITC, we need not show that value in our purchases or in our stock. Whereas in your IC, you need to show the same. So there is only one small difference, more or less it is being followed. The next one is contingencies and events occurring after balance sheet date before signing the financial statement. If there are any subsequent adjusting events or non-adjusting events in the accounting standards. So adjusting events have an effect. It existed on 31st March and before signing the balance sheet date, you have a event that happens. For example, there is a loss of fire on 31st March. You file an insurance complaint. The insurance claim comes within your date of signing. Say you sign the financial statement on 15 September. The claim comes within 15 September. Can I recognize the claim as income? Yes. Which standard says so? AS4. So this is what is there, each accounting standards. The next one is net profit or loss for the period, prior period item and change in accounting policies. Accounting the prospective effect, how you should write change if there is a change. We follow consistency. If it is not consistently followed, what should be done is there here. Prior period items is there in your tax audit report itself. So prior period items, if you are showing any prior period items, you have to separately disclose in your tax audit report. Same way in your financial statements also it should be separately. When does prior period item come? If there is an error of commission or omission in the previous year or the preceding year and you find it in the current year, that correction needs to be done. Then you have AS7 construction contracts that needs to be followed for your construction entities. So construction entities, AS7 needs to be followed. Revenue recognition more or less we follow. The problem is documentation. So we document how revenue recognition is followed. Generally when risk and reward is transferred only, we record the sale. More or less for 99.99% or 100% of the clients, We record only if risk and reward is transferred. That is what is told in Sale of Goods Act. That is what is told in Contract Act. For services, if there is only certainty of amount and certainty of collection and after service is provided, we record. This is what is given, what we follow. But the problem is documentation. So the AS9, kindly quote the definition section. When should revenue be recognized? So that can be quoted. Property, plant and equipment more or less follow. Now there will be a difference. Depreciation, here they have given only straight line method or WDV. They have not given the block method. Disclose it in the notes to accounts. Because in income tax we follow block method. We do not depreciate each asset separately. Since if you are following, kindly disclose it. You can disclose it. Cost application is matching. For example, say there is a car, motor car you are buying. Motor car has 28% to 43% or 50% GST, including your CGST, SGST, IGST and cess. So what do we do with that GST? What do we do with that GST? We capitalize. Why do we capitalize? Because we cannot take input tax credit. Same thing is told in AS10. 43 says that if you have not taken ITC, you can capitalize. AS10 says non-refundable taxes should be capitalized. Record it. That's what. More or less we are matching. We are following the principles of accounting standards. Where we are not doing is we are not documenting it. So income tax law itself somewhere comes into the standards. Since we are doing income tax series, I just want to compare the law and the standards. So somewhere we are matching. More or less it matches. So the only thing is that block assets, just right, we are following the depreciation as per Income Tax Act, Income Tax Rules 1962 and Section 32 of Act. So you can write it. If there is, why? Because in AS1 they have told, if there is a better presentation of financial statement to comply with the statute, to comply with law, so then you can show a separate disclosure. So to follow income tax law, I am doing block assessment method, so I can disclosure. That can be done. That can be done. You are not violating accounting standards. You can write in AS1 for better presentation or to compliance with statute, I am going away from the accounting standards, doing block depreciation, that is acceptable. Next one is effects of changes in foreign currency. Just wanted to say one thing. We are more or less following with the input and the settlement. So suppose we are importing or exporting some goods and we are receiving payment or we are making payment, if there is a difference, that exchange difference is being recognized. But on the closing date, there is a debtors balance, cash balance, bank balance or a creditor balance in a foreign currency, kindly restate it at 31st March rate. Please do it. That is what is the only non-compliance in AS11, or more or less it is followed. Because once you export and you receive a different amount, you export for $1,000, you export for $1,000, I'm just giving an example. You are getting, today the rate is 88 rupees, but to say 1 week later it becomes 90 rupees. I'm getting 1 month later and it is 90 rupees. I am receiving the settlement for 90,000 rupees instead of 88,000 which I have exported. The 2,000 rupees, what do? We show it as exchange difference. Yes, realized gain, profit on foreign exchange. So that we are doing it. We are not recording it. We are not recording that we are following the accounting standards. Then AS12 government grants. AS13 investments, again cost or value whichever is lower, and we do diminution for permanent as only permanent. For a long investments, diminish the value only if it is permanently held for trading. You can do it cost or fair value whichever is lower. So the same thing is there. Investment cost also we do some things here also. For example, if there is a dividend, pre-acquisition dividend, do we show it as income or do we adjust with our investments? Today date, say I have invested on 30th September, but dividend is given for, dividend has been announced on 28th September itself in the AGM. But since I am on 30th September, I made the investment. But dividend is received in my bank account because I have been an investor on 5th October. What do I do with that dividend? It is considered as a pre-acquisition dividend. What do I do with that? I reduce my cost of investment. Same thing is we are doing. We are actually generally doing. It is not offered as income. So this is done. Then the next one is accounting for amalgamation, very rarely there for non-corporate entities. It is applicable, but even for level 1 entity, it is not possible. AS 15, very important. This size of entity, they have to do something called as actuarial valuation for long-term benefits such as gratuity and long-term leave encashment. All the entities must do actuarial valuation. This is not for non-corporate. Even corporate entities must follow. A lot of financial statements do not have this particular actuarial valuation done for their financial statement. Tie up with an actuary, get an actuary valuation for your gratuity and your long-term leave encashment or any long-term benefits. A16 borrowing cost I already discussed. Before ready to use, capitalize. After it is ready to use, you can expense it off, which is more or less similar. Segment reporting, if there are segments, geographical segments or business segments, this has to be reported. There is criteria, reporting segment is the word, 10% of asset, income, revenue. So all that is there. So that please go through the AS17. That also needs to be reported. AS18 also needs to be followed. AS19, expense of that needs to be followed. 20 not applicable. More or less non-corporate entities, it will not come. Earnings per share isn't there. But all 27 is applicable, so it may be there. For banks or entities which are in the process of listing. So for them, it may be applicable. Consolidated financial statement also only for those entities. General non-corporate entities, your firm, HUF, AOP, this will not come. Cooperative society. Accounting for taxes on income, please do recognize deferred tax asset and deferred tax liability. So deferred tax asset and deferred tax liability is, for example, when there are timing differences. SASHANK, what are these timing differences? For example, TDS I have deducted in the current year. I have not paid within 31st October, which is the due date to file the return of income. What do I do in my income tax return? I disallow. I disallow that particular income. What will I do? Suppose in the subsequent year, 31st October, it has been paid. Say it has been paid on 1st Jan. So the next year income tax return, what do I do? I can allow. So basically what has happened, my provision of tax has increased because of this timing difference. So current year I have more tax than what I need to pay. In the future year I will pay my tax in a lesser amount. So that lesser amount I am paying in the future is a future economic benefit. So for that I have to recognize something called as deferred tax asset. I have to recognize something called as deferred tax asset. I am not going deeply into all the accounting standards because one accounting standards or two accounting standards I do itself, it will take the entire time. I want to give a coverage of all the items so that we have a basic idea. At least we know where to read and what to read, where to start and what. That is why I am just giving. So our taxes on income is there. Depreciation difference. 43B allowance, disallowance. Say your preliminary expenses. Preliminary expenses you can claim only 1/5. So all this will come under your deferred tax asset and liability classification. Before that 80IA, all these benefits also were there. Accounting for investments in associates and consolidated, more or less it is not there for non-corporate. Discontinuing operations, yes, any operations, kindly read the word definition of discontinuing operations. If it comes under that classification, kindly disclose it separately in your financial Interim financial reporting also very rarely applicable for non-corporate entities. Why, SASHANK? Because very rarely we prepare financial statements apart from the financial year. Quarter, half year, monthly, bi-monthly financial statements are generally not prepared for non-corporate entities. This is more or less applicable for listed entities who give results. But if you are a listed entity, accounting standards itself is not applicable. Indian accounting standards is applicable. So it will not, this will not apply even for listed entity. The next one is intangible assets. Intangible assets, again, in Income Tax Act, intangible assets are recognized. Only thing, goodwill cannot provide depreciation. But for accounting, you can provide depreciation. But you cannot claim the depreciation in your income tax returns. So only ensure that, but in income tax law, they have told only goodwill you cannot claim depreciation. You can claim on any other intangible asset, your patent, your royalties, your brands, your trademarks, your customer list. Lot of intangible assets are there. Go through all the intangible assets. All these put together only make goodwill. But these items can be shown as separate items, trademark, brand. So all these you can claim depreciation even in your Income Tax Act. The word here used is amortization. In the standards, instead of the word depreciation, amortization is used. This is more or less matching with your AS10. Only thing where AS26 should be read is research versus development. There is a concept of research and there is a concept of development. So research is before you develop the product, before you develop a prototype or you develop the software. So before going to software, say we are going to do an accounting software. Research phase is where I will see how many entities are there in India, how many people need an accounting software, what should be done, what are the criterias, what should be my pricing module. Those are all research phase. Development phase is when I actually write the code and develop that particular software. Why you have to know the categorization is research phase cannot be capitalized. AS26 is clear. Income tax law also needs to follow AS26. So if you expense of your research phase, they cannot tell to capitalize because your accounting standards is clear. Lot of case decisions code. So AS26 is very clear and development phase needs to be capitalized. So that needs to be done. That is why in your financial statements I will show you the word is always used intangible asset under development. They do not use the word intangible asset under research and development. They use the word only development. The next one is impairment of assets. So impairment, you compare your carrying cost with your, compare with the future benefit. So whatever you compare residual value, impairment you have to do difference. The next one is provisions, contingent liabilities and contingent assets. Generally provisions as accounting itself, we are all conservative. We do follow this accounting standards. What do we do when there is only probable outflow of economic resources? You have to recognize this. And there is, the amount is known, there is certainty of amount and there is an outflow of economic resources. So generally when do we do? So any event that arises out of past event. So any event that is going to arise out of past event which causes a probable outflow of economic resources embodying economic benefits. So that is what, for which you have to give your provision. So generally rent provision. When do we give rent provision? 12 months you are there in a particular place. 11 months you have paid. 12th month you have not put a provision. Yes. Interest, same way, yes. Some past, say I have purchased, come in past event. Provision comes based on that only. Contingent. So this is one thing we do not do for non-corporate entities. Contingent liability, please disclose. Your frivolous case, that is also a contingent liability. Contingent asset, you need to not disclose in the financial statements. Suppose they have, you should disclose contingent asset. So contingent liability you can recognize whenever it is possible. Contingent asset, contingent liability is in financial statement. asset you need not disclose anywhere. So next level 2, so I have just compared. So level 2, 7 accounting standards are not applicable. We will see what are the 7. So these are applicable fully. So AS3 is not applicable. AS3 is not applicable. AS17 is not applicable. AS19, 20 and AS23, 25. Okay, sir. So AS23 and 25 are not applicable fully. So these are the accounting standards which are not applicable. Now here 9 more accounting standards. So here there are 2 more accounting standards which are removed, which are AS18 and AS24. So you can just 2, you do not have 19 earnings per share, 17 segment reporting, 15 there is some classification, 19 leases, there is partial exemption. So I have not shown it, but there is partial exemption for leases, 15 also partial exemption. Segment reporting not applicable, your AS23 is not applicable, 25 is not applicable, 27 is not applicable, 28 is not applicable. 28 you have exemption, 29 you have exemptions. Then here again cash flow statement. So 2 more accounting standards from here is these 2 are removed. So AS18 and AS24 are not there. And what are the 8 accounting standards for level 4? So even if you remove this, this item also will not be there. For generally construction company, if this AS is only applicable for construction entities. So non-construction entities, this also not applicable. So more or less only 7 accounting standards are applicable for non-corporate entities which are level 4, less than 10 crores. But one more thing, less than 10 crores. Tax audit itself today is very rare, very, very rare. Why? Because that proviso is there in your tax audit report. If there is only payment greater than 5% and your receipt or receipt greater than 5% of your total receipts, you need to do tax audit. So that exception is there. So what are not applicable? I am just showing. The 7 accounting standards not applicable. 3, 20, 17, 21, 23, 25, 27. So these are all not applicable. So as I told, 7 accounting standards are not applicable. So again AS3, AS20, AS17, because 20 is more or less per share. It's for company. Even for your level 1, very rare you have it. Only in the process of listing you need to show it. Level AS21, 23, 25, 27 also not applicable. Level 3, level 4, the additional I showed, which is AS18 and AS24. But SASHANK tax audit report should I disclose? Yes. Clause 23 you still need to disclose. That is, there is no change in that. Financial statement you need not disclose your related parties. If you want, so also in the guidance, in the accounting standards, so this all comes in the preface of the accounting standards. So there's compendium on accounting standards, preface all these documentation comes. It is very, suppose you want to follow a standard. Say AS18, I want to disclose in the financial statement, you are free to. You are free to disclose, no restriction. I am just giving, you need not follow, I am just giving. If you want to follow, please go ahead. That is what the accounting standards is very clear. Here 14 and 18 is removed for your level 4. Anyway 14 will not apply. Very rare. I mean non-corporate entities, amortization will not apply. So we will see the exemptions. So I have been asked for a tea break. So we'll just go for a tea break. We will just start again in 10. Depreciated property that is still in use. So any property that is fully depreciated, you have to give notes. So all these disclosures are not needed. Revalued class of property, plant and equipment which would have been recognized had the asset been carried under cost model. What is the cost and revalued figure, and then there is retired from active use. So all this is not majorly required. Then disclosure for AS11. If there is some risk management policy that need not be disclosed for level 3 and level 4 entities. this more or less risk management policy and all is there. This disclosure is not needed for level 3, level 4. AS 13, other disclosures specifically required by statute, only that needs to be done. Others need not be done. What is required by statute to recognize? For example, 11.5 investment in trust. All these investments are as per 11.5 of Income Tax Act. That's it. That's the disclosure that is needed. This is the most important thing. This is the most important thing. AS 15, lot of people came and asked out. Actuarial valuation, when we need to do. There is exemption for level 2, level 3, level 4, when we need to do. So, if the average number of persons employed in the entity is 50 or more, then they have to be actuarially determined. So, employees are 50 or more, you need to do actuarial valuation. Less than 50, you just need to use some rational method to make provision for gratuity or leave encashment. So, actuarial valuation is needed for 50 or more. For this only you need to get a report from an actuary. So, this is what is necessary. Apart from that, any recognition from short term absence or non-vesting, that need not be applicable. So, all these are to do with ESOP. Any amount more than 12 months after balance sheet date, that need not be shown. So, all these principles are there. So, these disclosure, there are relaxations. So, AS 19 also, there are a lot of paragraphs which are relaxed. I am not going in greater detail to them because today the core is financial statement of non-corporate entities. I just wanted to show the accounting standards applicability. So, I am just touching upon, because doing this topic itself will take 3 to 4 hours. So, this is what is there in this particular clause as exemption. So, these are the exemptions given in leases. AS 22, level 4 entities, only the provision of tax shall be shown. So, only shall apply for current tax is the amount of income tax to be determined. Only this is applicable. Tax expenses should be included. So, only current tax should be shown. You need not show even your deferred tax for your level 4 entity. So, small entities, provision for income tax should be shown. So, partnership firm, provision of income tax needs to be shown. Sole proprietor, we go in the garb that income tax comes under drawings. We do not need to put provision as such, because in sole proprietor it comes under drawings. Even in HUF you can show it as drawings, but in partnership firm and AOP at least ensure that provision for income tax has been put. Because why? Sashank, why do they put drawings? Very simple. Sometimes your interest on fixed deposit may not come in your sole proprietor balance sheet and P&L, because it may be a personal income. Dividend income is a personal income. So, income tax put together comes as a personal amount. So, we can show it as in your drawings itself. You can show it as your drawings, or you can adjust it necessarily. So, this is what is there. Relaxation is there for impairment also. Value in use can be used as a reasonable estimate. What is the future value in use? That can be compared for level 2, level 3 and level 4 entity. So, impairment of individual asset, all these are there. So, I am just trying to show what are there, what are not there. Just a brief recap. AS1 applicable for all entities, AS2 applicable for all entities. Cash flow only for level 1. So, level 1 financial statements include cash flow statement. Then contingencies, events occurring after balance sheet date applicable. Net profit for period, prior period items and change in accounting policy applicable for all. Construction contract applicable for all. Revenue recognition applicable for all. So, this is useful for your documentation. So, what is the type of level of entity? You just document what accounting standards are applicable. Even in that, AS7 will not be applicable if you are not a construction. So, you can write, I am not a construction entity, AS7 not applicable, boldly, no issues. AS10, AS11, AS12 government grants come only when you receive government grants, or else it is not applicable. You need not even show it is needed. Accounting for investments, only what is statutorily required to be disclosed should be disclosed. Amalgamation, there is no amalgamation means again In your documentation, you just need to tell no amalgamation, no need documentation. That's it. Employee benefits actuarial valuation for this level 2, level 3, level 4 entity, 50 or more employees, you need to get actuarial valuation. And less than 50, you need not get. Borrowing costs applicable for all, segment reporting only for level 1, related party level 1 and level 2, leases level 1 only applicable, others have disclosure exemption. I showed what are the clauses. There are various clauses, so those exemptions are there. It is there in the preface. So preface of compound, so accounting standards, preface to accounting standards has all these particular things where I have to read it. It is there in the preface to accounting standards. So consolidated financial statement not applicable for this. Taxes on income, only current tax is shown. Associate entities, again this is not applicable to all. Discontinuing operation, there are no discontinuing operation, accounting standards does not need to be complied with. I mean there is no, the entity does not need to follow that accounting standard. Interim financial reporting, only financial year is no requirement for interim financial reporting. So all these we can just write it as a disclosure. Consolidation also the same thing. Earnings per share also the same thing. Intangible assets, only for this there is a disclosure exemption. AS 27, joint venture, again not applicable. Non-corporate entity, very rare. If it is there, disclose. Only for level 1. Impairment of assets, disclosure exemptions are there. Provisions, contingent assets and contingent liabilities, disclosure exemptions are there. So additional requirement as per council decision, this is very important. An MSME which avails exemptions or relaxation, so I told you earlier, suppose there is exemption or relaxation and I want to follow, I can follow, council decision is there. So an MSME which avails exemptions or relaxation to which by way of, by the fact that it's an MSME or the level of MSME and it has complies with accounting standards, so far it is needed. However, if a level 2, level 3 or level 4 entity qualifies for an exemption but no longer qualifies for exemption in the current accounting period, it shall be applicable from the current period and the previous period shall need not be revised. So what it is telling, last year I am doing 90 crores turnover, I am doing 45 crores turnover, that means I am a level 3 entity. Next year I am doing 55 crores turnover, I become a level 2 entity. So from level 3 entity to level 2 entity if I go, there are more complaints of accounting standard for level 2. Generally in financial statements, now I will show you, you have to show comparison. Current year and previous year comparison is there in your financial statements. So for that you can, here they have given a relaxation. So current year I am level 2, previous year I am level 3, previous year figures need not be revised. It need not be revised. You can just tell the previous year is level 3. The accounting standards for level 3 has been followed. Just give a disclosure. If you want to revise, please do. That is no thing. But the council has given a relaxation. So if it is level 2, the fact that the entity was covered in level 2, level 3 or level 4 as the case may be in the previous period and it had availed exemptions or relaxation available in the level of entities shall be disclosed in the notes of financial statements. The facts that the previous figures have not been revised shall be disclosed in the notes to financial statements. Like I told, just disclose. You need not change the figures. No need to do additional work. The next one, no exemption or relaxation for 2 years due to change in status. What does this mean? If an entity is level 1 and then it goes down to level 2, then what happens? So entity is level 1 and subsequently it ceases to be covered and gets covered in level 2, level 3 or level 4. The entity will not be qualified for exemption or relaxation to that level until the entity ceases to be covered in level 2 for level 1 for 2 consecutive years. What does this mean? Current year, from last year I had 250 crores turnover. This year I have done 230 crores. So 1 year there has been a slip from level 1 to level 2. The next year also, so that year I will not have, I will still be a level 1 entity. I will not have any exemptions or relaxation. The next year, suppose I go to 220 crores, then 2 years consecutively you are a level 2 entity. So you will become a level 2 entity, you can take the relaxations and the exemptions. Suppose it becomes 260, then you will still continue doing your level 1. So for 2 consecutive years you should be a level 2. So from a level 1 to level 2 you go, 2 consecutive years you have to go down that level to have those exemptions and relaxations. You can ask me an example. From 250 I go to 45, somebody will ask me, why it was 270, then it went to 240, then it went to 45. What will you do? The third year you will consider it as a level 2 entity. You will consider it as a level 2 entity. That is my interpretation, because for 2 consecutive years your level 2 or lower. Your level 2 or lower. So you can take the exemptions for level 2 entity, you cannot take it for level entity. So this is also being covered for a drop in level 1, level 2, level 3. So from level 2 you are dropping to level 3 or level 3 to level 4, the same exemption policy is applicable. But remember, when you are stepping down it is 2 consecutive years. When you are rising up from going to level 2 to level 1, that year itself it becomes applicable. This is what is there. So relaxation is done only if 2 years consecutively you fall the level. But you rise up 1 year, you will become level 1. For example, I will just give one practical example. There is a trading company which does 150 crores turnover. I am just giving an example. Suddenly 1 year they have some big order. Suddenly they purchase and they are just trading. So they purchase and they sell another 100 crores or 150 crores. So generally they do 150 crores for 10 years. 1 year they do 300 crores. So what happens is 23, 24 they did 120, I am just giving 150, 24, 25 they did 300, again they went back to their 150. What do I do in that scenario? For 2 years, so 24, 25 as well as 25, 26, I will still be level 1 entity. This is where the exceptions are there, but we cannot do anything because we should not be non-compliant. So that needs to be followed mandatorily. Then the next one, voluntary compliance. As I said, suppose level 2, level 3 or level 4 opts to not avail exemptions, it shall disclose the standards which it has availed exemption and relaxation. So I want to disclose related parties, you can go ahead, but you have to tell what all exemptions you have taken. Suppose you want to take only partial exemptions. Partial exemption also, it should not mislead. Suppose it does not mislead any person or public, you can do partial exemptions. And the next one is this 50 or more classification. I have any valuation, if employee is 50 or more, that needs to be done. Now charitable activities. Charitable activities, I will show cash-based accounting. Before that, preface to accounting standards has a discussion in cash basis of accounting. So the word used for charitable activities, when accounting standards become applicable, if you are having fully commercial activities, accounting standards in respect of any enterprise, whether in corporate, cooperative or other form. So charitable trust can be in any form, engaged in commercial, industrial or business activities irrespective of whether it is profit oriented or not. So you are doing some commercial, industrial or business activities, or it is established for charitable, whether it is profit oriented or not, still you have to do. School you are running, hospital you are doing, or any other charitable activity which is commercial in nature, 100% they have to follow accounting standards. So schools, hospitals all need to follow your, schools, colleges, hospitals all need to follow your accounting standards. Fully non-commercial activities. So if accounting standards will not apply if the enterprise is doing fully non-commercial. So it does not carry out commercial, industrial or business nature. Any activity of collecting donation and giving them to flood affected people, all these are non-commercial. So this also accounting standards will not apply for these type of entities. Partially commercial and partially non-commercial. Accounting standards are not applicable only if a part of the activity. So accounting standards are applicable even if a small portion of activities is considered commercial industrial, the accounting standard shall apply for all its activities including non-commercial. This is where there is an interpretation issue. It is still not clarified in any institute guidance or publication. I will just give an example. Putting fixed deposits, investing in fixed deposits or making an investment in mutual funds or share markets. A lot of charitable organizations do it today. Is it a commercial activity or is it a non-commercial activity? Because it is a nature of commerce. To be very honest, you are investing in fixed deposit, you are getting interest. Why are you investing in fixed deposit? You are getting interest to beat inflation. So it is also in the nature of commerce. So if I receive donation and put fixed deposits itself, it may come under this and fully accounting standards may become applicable because fixed deposit is commercial in nature. Some people say no, it is not commercial, it is just a way of investment. So there is an open to interpretation. To safeguard, I will generally tell, since it's a public forum, to safeguard yourself, better to follow accounting standards. At least the cash basis of accounting, there is a technical guide, I will be showing that shortly, that can be followed. So generally for charitable trust, fully non-commercial, don't need to do. If they don't have FD, nothing, fine. Fully commercial, you have to do accounting standards. Partly non-commercial, partly commercial, please follow accounting standards. Yes.
According to the interpretation, because there is a provision up to 20% of the total receipt we can do a commercial business. According to my opinion, the third is applicable only for that one. Because 20% they are given the relaxation.
That is GPU, that 215 proviso, that is fine, but any, even if you do more than 20% or even 5%, that will only come. The third one will come. Even if I do 40% profit, it is fine. This will come. So this won't be a problem. But why they have not thought it through for the fixed deposit? Even my opinion sometimes is, you can consider putting fixed deposit is non-commercial in nature if they just get donation and make payments. But tomorrow if the entity or you as an auditor is going to be questioned, this is commercial, you don't know what kind of peer reviewer or who is going to be sitting in the disciplinary committee or who is going to be there. For example, two trustees are fighting in a trust. First thing what they will do, they will tell the financials are not proper, not properly audited. What they will go put a disciplinary case on the auditor. Ultimately we will only be caught in that particular activity. He has not expressed his opinion fairly. He has not followed accounting standards. He needed to follow accounting standards. So for trust, so one more thing I will just tell, apart from this for trust, one more thing which is very necessary is depreciation you need not claim as an expenditure in your income tax law, because when you capitalize the asset itself, the full amount you can claim it as an application of fund. But as per accounting standards, you need to put depreciation. So kindly put depreciation in the financial statements, or you write a note to disclose that since it is fully applied, there is this for the compliance in statute, depreciation is not a allowable expenditure in income tax act, so the same is not followed. But still my better preference is kindly put some depreciation, some straight line method, some value of depreciation you put, disallow the same, because then you will be in compliance with accounting standards. So cash basis of accounting, this is just a small thing. There is a technical guide which has come last year, but what we should disclose only I am just trying to show. So in disclosure, standard required, if fundamental accounting standards is not followed, fact should be disclosed. In cases where the preparation of financial statements are done on accrual basis, have not been done on accrual basis, the auditor should qualify. However, suppose, so if financial statement must be followed in accrual basis, but if it is not followed, auditor should qualify. However, if there is no statutory requirement on accrual basis and financial statement have been prepared other than accrual, In Income Tax Act, cash basis is a valid applicability. In your LLP Act, you can prepare your accounts in cash basis. It is allowed. So wherever cash basis is allowed in law, auditor should just tell the basis of accounting followed without a qualification. So the law should allow cash basis of accounting. So generally it should follow accrual. But generally all the entities are going to follow income tax law. In India, all the non-corporate entities must follow income tax law. So you can do cash basis of accounting. Just kindly tell in income tax law, cash basis of accounting is a recognized method as per section 145 of Income Tax Act. So that the example of non-qualification disclosure in your audit report should have this. So this is what is the write-up. I will just tell it is the policy of the enterprise to prepare its financial statement on cash receipts and disbursement basis. On the basis, revenue and related assets are recognized when received rather than when they are earned. Expenses are recognized when they are paid rather than when obligation is incurred. In our opinion, the financial statement give a true and fair view of the assets and liabilities arising from a cash transaction of dash at dash, and the revenue collected and expenses paid during the year then ended on cash receipts and disbursement as described in note X. So note in financial statement should tell that cash basis is there. That note reference should come in your audit report. In 3CB, just give this. If you want that observation and qualifications or comments, there is a particular line. You can write this particular line in the same to safeguard yourself. So other key areas, depreciation. So available for use, here you use put to use. So this classification difference, you can disclose the same. And the impact, if there is any impact, you can enclose. But generally, common parlance, ready to use and put to use are almost the same day only we will be putting in our 3CD or any record. If you see, most of the time the invoice date, ready to use, put to use date practically becomes the same day until and unless there are exceptions. If they take time to install, there are 10 days it takes time to install, only when it is put to use you can record. So that is it. Sir.
It is safer to follow the accounting standard with regard to trust. The FD also there is an interpretation. Report, I am supposed to qualify whether it is a commercial in nature. Suppose if I say it is commercial in nature, then as per 115 BPG automatically we calculate 30% tax. Because tax and other is exempted by government only.
So there business is used. Sir, there the word used is business or trade or something is there. Sir, here commercial activity is, here they have told commercial business. So we can do something. Ejusdem generis, there is a concept. So industrial business or commercial should be read as equivalent to industrial business commercial, that I can do it. Then it is not a commercial activity. Putting FD is not a commercial. I see the word commerce. If I see the word commerce, can be interpreted as commercial. Somewhere you have to have a documentation, not commercial. If you are taking the interpretation that it is not commercial, kindly document it somewhere in the working papers, not needed in the financial statements, but at least in the working paper, why accounting standards is not followed, kindly disclose the same. Have a working paper for the same, because every auditor, that is why it is an opinion based profession. I will have a different opinion, sir will have a different opinion, everybody will have a different opinion. This is open to an opinion. There is no hard and fast rule in this particular clause. So that is the main needed thing for this. So also I just wanted to compare, mercantile system is followed, cash system auditors must disclose as mentioned above. Tax audit report I am just comparing, change in accounting method. So disclosure and AS1 and AS5 also should be followed for the same, we have already discussed. ICDS and in AS you can, there is a comparison, carve in, carve out you can see. Method of valuation is almost same, clause 14 is same with AS2. But in 145A it is inclusive of taxes, whereas it is not inclusive. Guidance note what they are telling is a reconciliation statement is needed for that clause as a working paper. In our for purchase, sales need not be recorded inclusive of tax, purchase need not be recorded inclusive of tax, closing stock need not be, opening stock need not be, but guidance note says there should be a reconciliation. Then 23 related party, as I already discussed. And these are my details. Anyway, I will be sharing cash basis of accounting and then we will go to financial statements. So seminar is not yet over. So I will just show cash basis. So cash basis of accounting, there is a technical guide. So there is a technical guide which has been released. So I will just show a quick. So quick thing of cash basis of accounting. Again, meaning and features of cash basis, treatment of income, expenses, assets and liabilities, and disclosure based on accounting standards. It's a very small publication. It's their institute. There's a technical guide on accounting. Why I am telling to refer to all to safeguard us? Because we are following it, but there should be some descriptive. Suppose somebody is doing a disciplinary proceeding, somebody is asking, so we can tell the institute publication is there which supports my evidence. It's a supporting evidence of what is being done. So nature and features, cash basis of accounting recognizes transactions only when cash is received or paid by the entity. Measurement is focused only on cash and bank balance and changes therein. Revenue is recognized only when it is actually received. Expenditure is recognized only in the outflow of cash. This is there in the technical guide. This is the exact words. So only when it is received, recognized. This would result in recognition of cash received or spent during the year, though it may relate to a different period. Further, non-cash items, only two non-cash items they are telling shall be done. Depreciation and impairment loss do not get, so that can be recognized. So depreciation and impairment can be recognized. Non-cash nature, recognize the. So what are the items is, so cash basis you need not recognize they are telling, but in the guidance note, these two items please recognize they are a particular clause. So balance sheet, P&L account or income and expenditure account, this is the financial statement. Receipts and payment account, cash flow applicable for level 1 entities. So what is their revenue recognition? Here risk and reward shall be earned, there are no uncertainty regarding consideration. So AS prescribes revenue from sales and services, rental on investments and dividends. So only we have to, when risk and reward is transferred, there is no uncertainty on uncertainty of amount collection. You can recognize it as a income as per AS 9. As per technical guide for your cash basis. When cash is received, you can recognize. It is recognized on receipt basis. But one thing is very clear in technical guide, pay very close attention to this. In case revenue has not been received in cash, so you have not received revenue. However, tax has been deducted and deposited by the payer case. So what does that mean? In 26 AS it is appearing. So I am an auditor, I am doing cash basis of accounting. 90% of auditors do cash basis, 99% auditors do cash basis of accounting. So cash basis of accounting, what I do, my client, for him liability happens when I put audit fee provision, because when your provision itself 194J is applicable. So provision on provision itself 194J is applicable. That amount. So I will not come in that particular year. So in cash based accounting, amount has been deducted and paid. So it is shown in your 26A. What should I do? Revenue shall be recognized to the equivalent of tax amount deducted at source. This is what they have given in the technical guide. Technical guide is not mandatory, it is recommendatory. So it generally in 26AS it reflects the tax amount at least should be shown as a revenue. So 1 lakh rupees I am putting provision, 10,000 rupees is your TDS. This 10,000 rupees should be, if it is up to your 26AS, it should be recognized as your income in as per your technical guide. So this is what is given in the technical guide. Why? Because that receipt has happened. Next year you can adjust it with my refund. So the next year I can adjust it with my refund. You need this year, you can offer it even in the next year. But in your P&L this should be there. So cash basis of accounting showing that P&L this amount should be there. The next one. But you have to show in books of accounts. is for showing in books of accounts and accounting it. We are carrying, you can forward in your returns. 10,000 here. So you can show it in, but there will be a lot of issues in CPC that you have to take care of the compliance. But this is what is given in cash basis of accounting. Suppose you are not recognizing the same, there is a deviation from the technical guide. Technical guide is recommendatory in nature. It is not binding on the auditor who is giving an opinion or anything. Like the accounting standards is mandatory, needs to be followed. This is recommendatory. Just if you want, you use. If you don't want, you have a different interpretation. Other interpretations can be taken. Documentation of the same needs to be done. That's it. So the next one is AS12 government grant. When there is reasonable assurance that the entity complied and grants will be received, you can recognize. Here only if grant is received, you can recognize it as income. Then in relation to expense, all these. So gratuity, actuarial valuation will not come here because you have to recognize only when amount is paid. Only when it is paid. Here all the provisions should be recognized. So share based pay, so employee benefits, for all employee benefits you have to recognize when service has been given. What does this mean? 12 months entity employee has done service, only 11 months salary is paid, means only 11 months you can claim as expense. 12th month you can't put a provision. Next year I paid 13 months, next year 13 months can be taken as expense. So that is what is there. Only when it is paid that amount can be taken as expense. So the information enables the nature of employee benefits. So you have to tell what is the nature also. Just tell what is the nature of employee benefits. Salary, wages, something else, gratuity, PF, contribution to PF, that should be disclosed separately. So borrowing cost also, cost of qualifying asset. Acquisition, if it is directly attributable, you can capitalize. Here borrowing costs are capitalized only when they are paid. So only when they are paid you have to recognize the same. Paid after subsequent completion of all the activities necessary for qualified assets shall be expense of. So only in paid interest cost should be recognized. So all these leases also shall be recognized only when it is paid. Here accrual basis you can do it. So I am just doing AS11. So AS11 generally restatement is in there. So sales and purchases are also recognized only when it is received or paid. So there is no exchange difference, what we learnt. But cash and bank balances in the year end, if there is any foreign currency exchange, that needs to be restated. Only that should be complied in AS11 for cash basis of entities. The non-cash expenses, impairment and depreciation shall be done. So in accordance with AS10, each part of plant and equipment shall be shown. AS28 impairment, that also needs to be done. Tax paid and tax refund. So tax paid shall be recognized as a expense in the P&L. So basically what you can do, I told no, revenue should be recognized for that 1,10,000 example I gave. So it is as good as your, what entry would you pass for that 10,000 rupees? Tax paid account debit to income account. You can set it off. P&L will be nullified to that particular extent. If you create it as an asset, it is fine. The next year you can take it as an asset also. In case the entity has paid tax more than the current tax and it is reasonably sure that there would be a tax refund. What it says, advance tax or TDS is more than your tax payable, you are sure that you will get refund. Recognize the excess amount as asset. So 1 lakh is my self-assessment tax payable, TDS is 80,000, self-assessment tax is 40,000. So totally 1,20,000 tax I have paid, 20,000 refund. What should I do with that? Show it as an asset in my balance sheet. So that is what is given. Show it as tax amount refundable in the balance sheet. So this is what is given. Accounting standards in relation to liabilities. Liabilities shall be recognized when cash is received and considered as discharged. So when liabilities can be recognized only are advances. So I have not provided a service and I have done some activity, then liabilities can be recognized as this, but more than that only for borrowings. Even advance, it is revenue as and when it is received. Only your bank borrowings will come here. In this general framework, only bank borrowings will come. In relation to asset, an asset shall be recognized when future economic benefits are there. Under cash basis of accounting, they are recognized when there is future economic benefits flow to entity in the future and possess a cost and value which can be measured reliably. All these conditions should satisfy and the amount should be paid. So that's when you will be recognizing in cash basis of accounting. Inventories, lower of cost or net realizable value. So all these are there. So this disclosure should be done. Inventories disclosure is anyway done, mandatory. AS10 only when it is already done. So when it is paid only it shall be done. So it is expected to be used for more than 12 months, you capitalized. Less than 12 months, expense it off. So a lot of people nowadays, mobile phone, they expense it off because some people use mobile phone for less than 1 year. So that interpretation can be taken, less than 12 months. So if there is a pattern, under accrual basis when there is probable outflow, here in cash basis when it is paid, all these criteria and it is paid, it should be recognized. Intangible assets also the same thing, when it is paid it should be recognized. Loans and advances to employees, if it is a loan and advance, recognize it as an asset. Say it is 15 months, 13th month salary I am paying in the 12th month, it is an expense. It is a expense. Only which I have actually given loan, staff loans, staff advance which I have to recover later, that will not come here, where I am recovering it back from the employee. So disclosure, I have already told what disclosure needs to be done. Cash flow, level 1 requires to prepare cash flow. Prior period adjustment, if there are any errors, shall be disclosed separately, same thing as AS5. Segment reporting also is there. Related party disclosure also, when it is paid it should be done. So sale, purchase and transfer. So related party, sale, purchase and transfer of property, services rendered, interest on loan, borrowings, receipt of salary, honorarium or any other non-monetary benefit shall be disclosed. So only current tax will come in cash basis. Current tax also will come only if it is tax is paid or there is a refund. So this is what is there in cash basis of accounting. Now I will just show the guidance note for financial statements. So we just have an hour left. So the guidance note on financial statements I will just show. So this is the guidance note. So this is the guidance note. In fact, this guidance note has come on August 2023. It is a very old guidance note. So wherever I have gone and done CP or anything in any entity, for tax audit or anything, I always told one particular thing. For FY 23-24 itself, you should have prepared in this particular format. Why? Because there is going to be a comparison. So for this year, since we are going to do for 24-25, those who have not done for 23-24, you have to prepare financial statement for both the years put together. Both the years put together financial statements need to be prepared in this particular format. So the format I will just show. So I have just shown the direct guidance note. Actually better than this, how better than this, the institute has actually given an Excel file. This is fine, but better than this, I will show the institute has given an Excel file based on the guidance note. So this is where we can use the institute publication and benefits. So I will simply show. So how to find it? So guidance note on financial statement of non-corporate entities is a very simple process. You just go to the link. Here itself you have the format. So you have the technical guide for NPOs, checklist, all this. Cash basis of accounting, you have the checklist. This is so financial statement format, you directly get the Excel, it's there in the institute site. Generally in the search itself you will get, but anyway. So it is there in the institute site, you will get this particular Excel file. So this is based on the guidance note. So this is the particular format. So I am just going to show the format. So what is there? So what is there in this particular format is as follows. So this is the format. You have an Excel file for the same. So both years comparison, you can give links to the notes. So why I am telling 2 years is, the format is current reporting period and the previous reporting period. So I assume that everybody has done company accounts. Company accounts has been verified. So this is more or less, there is no big change from your schedule 3. It is more or less schedule 3. Whatever you are having as your schedule 3 file itself, you can convert it into this. But anyway, institute has given a separate Excel file. So the word used here, instead of the word equity and liabilities, the word used here is owners fund and liabilities. So owners fund can be partners funds and liabilities. Suppose you are doing for a firm, it is partners funds and liabilities. So owners funds, you have owners capital account, owners or partners capital account, owners or partners current account. So all this will be shown here. So you can show negative figures also here. So current account, suppose it is negative, what to do? You can disclose it here itself as a negative figure. Debit balance will be disclosed here itself as a negative figure. Can be done. Reserves and surplus. So from a T-shaped format, again we are going to a vertical format. Almost the same. Same thing. You had equity and liability, share capital, reserves and surplus. Same thing is only there. Owners funds and reserves and surplus. So reserves and surplus, generally in partnership you do not have any retained earnings. You may have general reserve or some other reserve. Retained earnings concept, generally you add it to your current account. You generally add it to the partner's current account. You can continue doing that. You can continue doing that. You need not change your policies. Just because one financial statement comes and shows reserves and surplus, you need not add it to reserves and surplus. We can add it to the capital account, nothing wrong, because that is the accounting parlance. You need not keep your reserve. Sole proprietor, directly add it to the capital account, no issues, no issues. The next one, reserves and surplus, almost the same. Long-term borrowings, deferred tax liabilities, other long-term liabilities and long-term provision. In fact, schedule 3 words have not changed. So they use the word non-current liability. In schedule 3 it is used other long-term liabilities. Same word is only used here also. Other places you will have current and non-current. Here you will have long-term. So long-term borrowings. So long-term borrowings, what should be shown in notes? Deferred tax liabilities, long-term liabilities, long-term provision. What should be shown? I will just show the disclosure. Then you have your current liabilities, short-term borrowings, trade payables, other current liabilities and short-term provision. Same thing. There is no change from schedule 3. There is no change from schedule 3. The next one is property, plant and equipment and intangible asset. Property, plant and equipment, intangible asset, capital work in progress, intangible asset under development. Same 4 classifications there in schedule 3. So whatever is the schedule 3 accounting standards balance sheet and this, there is no change. Non-current investments, deferred tax asset. Always remember deferred tax, show it as net figure. Asset minus liability. If asset is more, show it as deferred tax asset. If it is a liability, do liability minus asset and show it as a deferred tax liability. Long-term loans and advance, other non-current assets, kindly show the same. Then current investments, inventory, trade receivables, cash and bank balances. So in schedule 3 it is cash and cash equivalents. Here it is used cash and bank balances. Why? Because here we can use our accounting standards 3. Accounting standards 3 uses the word cash and bank balance for your, because your FD and all can be here, up to 12 months FD can be shown here. Short term loans and advances. So actually before when schedule 3 came, they asked what if there is a difference between the accounting standards and statute. Statute prevails, that's why you use cash and cash equivalents. But generally the word in accounting standards is cash and bank balance. And then other current assets. So for this current and non-current asset classification, same thing what is given in schedule 3, the same thing is given here. So an asset is current if it satisfies any of the following criteria. So asset and liability I am just showing when it following criteria. So it is expected to be realized or is intended for sale or consumption in the normal operating cycle. It is primarily held for the purpose of being traded, or it is expected within 12 months after the reporting dates to be realized, or it is cash and a cash equivalent unless it is restricted from being exchanged or used to settle a liability for 12 months after the reporting date. So all these items together will be current. So suppose you have a fixed deposit more than 12 months maturity, it will not be coming under current because it is restricted from being used, because you have to pay some penalty for it to be used. So operating cycle, what is operating cycle? It is the time between acquisition of asset for processing and realization in cash and cash equivalent. Where the normal operating cycle cannot be recognized, you will take 12 months. So what does that mean? Operating cycle means from the date I purchase a good to sell it and realize that amount. That is an operating cycle. So I purchase a good from my supplier, I then do my manufacturing process, then I make my sale and then I realize that amount. This is what is my operating cycle. Suppose I am not able to define my operating cycle, it is 12 months. But anyway, so within the normal operating cycle it will be considered as this. Liability, when it will be classified as current or non-current, the same thing. It is expected to be paid, settled normal operating cycle, held primarily for the purpose of being traded. It is due to be settled within 12 months after the reporting date, and does not have an unconditional right to defer after the reporting date. All other liabilities shall be classified as non-current. Also, what is trade receivable and trade payable? Sometimes creditor and debtor is considered as trade receivable and trade payable. That also has a definition. Same thing is there in schedule 3. I am just doing a repetition of what is there in schedule 3. So trade receivable is if it is on account of goods sold or services rendered in the normal course of business. So paying rent is also a trade payable. So this is also normal purchase payable for account of goods or services received in the normal course of business. So rent payable also you can put as a trade payable. So all these you can put it as a trade payable, which is in the normal course of business. So to come to this notes, rather than showing in this for the balance sheet notes, I thought better to show in the Excel format because it will be in the more understanding kind of format. So balance sheet they have given a separate sheet. So each item they have given the notes itself. So basically you just need to delete or add, you don't need to add, delete notes which are not needed, not required. So this is what we have to do. So note number 1 is the brief about the entity. That is what they are telling. So non-corporate entity, what kind of entity? Partnership, sole proprietorship, trading, all that you can write. Note number 2 is your significant accounting policies. As we discussed, all the accounting standards we complied, no? All what we are doing as an accounting policy, we should write in note number 2. So note number 1, some places, you don't want to write brief. This is institute format, so you can directly take it. In your schedule 3, you write this as note number 1, you just import it there, that also can be done. But if you are using schedule 3 format, just one thing. Even in our institute format, I just wanted to tell one thing. They have used the word equity and liabilities, which is not as per guidance note. It is actually owner's fund and liability. That's what we had seen. But in the institute publication Excel file itself, this error is there. If you want, you can write equity and liability, is not a problem. Owner's fund is considered as equity, but equity concept generally we take it with our shares. So that is the thing, but it can be taken. It's not technically wrong, but it is there. If you want, you can change it. So these tinkering can be done. Significant accounting policy is there. The next one is owner's capital. So if you see owner's capital, here itself they have given the share of profit, given opening balance, any capital introduced or contributed during the year, remuneration can reduce, remuneration, if it is current account you can add, interest you can add, withdrawals you can reduce, any share of profit you can add or loss you can reduce. See, here itself they have given that you can adjust your profit and loss in this statement itself. You need not show it in reserves and surplus. So this is what I told. This what we think is no, their reserves and surplus is given. Should I show retained earnings like schedule 3? No need. Whatever we are following for so many years, that can be continued. But the thing is, you have to show comparison. So this is 1 year, the next year comparison, you copy paste this box below and show the previous year. So for everything comparison, or else previous year, this itself is sufficient. Overall also is sufficient. So you can show the overall movement. The next one. So note 5 to note 4 to note 6. So reserves and surplus, what reserves should be there? If you want, you can show your undistributed surplus, that is not needed. These 3 reserves will be definitely there. Capital reserve, revaluation if you are doing reserve. Third one, if you are having any other statutorily required reserve or general, there is a provision in the deed. Every year 10% should be transferred to general reserve. In partnership deed this can be put. That can be transferred here. Earlier also you would be showing it as a general reserve. Same thing will be continuing here. Then borrowings. This over the schedule 3. Schedule 3 we show it separately. In short term we show it in the notes below. But in the institute format, this format I somehow prefer because you have long term here. You also have your short term here. Easier to read and easier for our preparation. If you want, you can go by your schedule 3 itself. That no restriction. This tinkering we can do. What criteria is required? What criteria is required is you should tell term loan from banks or other parties, whether it is a loan repayable on demand term loan or deferred payment. So repayable on demand will have overdraft. Term loans is your general term loans. Any other deferred payments you can show. Apart from that, schedule 3 you have to show nature of security, you have to show terms of repayment, you have to show where terms are guaranteed by proprietor. The same disclosure is there. So the same disclosure is there. So secured, unsecured. So first you show secured loans, then you show your unsecured loans. Other than that, deferred liabilities, any loan received from related parties, any current maturities of finance lease obligation or any long term lease. So any lease payable is also can be shown here. Current maturities of long term debt also you can show in the other loans and advances. Nature of security. So what should be shown is nature of security. terms of repayment and where the term loan is paid. Then the next one is deferred tax liabilities. So deferred tax liabilities and asset, they have just given more or less certain items. We can have more items. So they are told expenses provided but disallowable on payment basis. 43B. So 43B, if you pay beyond the due date, you cannot claim. 43BH, you have to pay within that year ending or within that MSME time framework. So that if you pay beyond that, payment basis. Provision for debts. This is previous year figure, change or benefit, current year figure. Or you can put previous year, current year change and closing. But put the year correctly. Whatever you are putting, put the year correctly. Difference between book depreciation, tax depreciation, all these are given. So these are the deferred tax items. So the next, notes. I prefer the institute for this long term and short term. Schedule 3, we cannot do this. Schedule 3 cannot be done this way, but non-corporate, the guidance note is given there. Ministry of Corporate Affairs, Companies Act is applicable, all that. Here it's the guidance note of our institute. So we can directly follow this. This format I personally prefer because you have your long term and short term. So provision for employee benefits, you do have they'll have long term and short term benefit given for provisions. Leave encashment also the same thing. Other provision for income tax can be shown here. Any other provisions here? Other long term liabilities, advance from customers and any other long term show here. So trade payables. Directly taken from schedule 3. But there is one small change from schedule 3. Schedule 3, the word which is micro and small enterprises. Here also I think the word used is micro and small enterprises, but I think in the format there is, okay, micro, small, medium, all three should be disclosed. So in schedule 3 you needed to disclose only micro and small. Here you have to disclose micro, small and medium. Total understanding other than the same. The biggest problem in this corporate entities itself to get micro and small is a great difficulty. What to do here? Ask your non-corporate entities and check the level, check whether it is possible or not. Just check possible or not. See the practical possibility of the same. If you are not able to do it, kindly document it at least. Also get a management representation for MSME disclosure, because today everyone is liable in MSME Act. Suppose they have not paid within the time limit, for every entity 43BH is applicable for micro and small. Medium may not be there, but micro and small, that applicability is. So kindly ensure your clients, not only for this 43BH, mainly 43BH. You cannot give an excuse that I cannot find micro small. You have to do it, because in tax audit report under clause 26 we are separately showing this 43BH disclosure. So kindly be very careful in this particular. Then so MSMED, disclosure relating to MSMED, any amount remaining unpaid at the end of the accounting year, whether it is paid within the time limit. Any amount of interest paid, any amount of interest paid on delay, all these disclosures should be done. Then other current liabilities you have, this is in schedule 3, this current maturities has gone to borrowings. You can show it here, or you can take your schedule 3 interpretation and put it in borrowings itself. Current maturities they have given in two places. Interest accrued but not due, interest accrued and due on borrowings also you can add it to your borrowings like schedule 3, or you can show it here separately. Income received in advance, other payable. So all this can be shown here separately in your current liabilities. Other current liabilities, so your TDS, GST, PF, ESI, all this will be coming here. They are not trade payables, they are statutory liabilities, so it should be disclosed separately. Even in schedule 3 they should be disclosed separately. Okay. If you want, you can give. It is additional work. If you want, you give. If there's no need, it's not requirement is there. If you want, you can give. Yes. So this is a major issue. Most of the non-corporate entities, I don't think, follow depreciation this way. If you are following block assets, kindly give that as your disclosure, as your notes. Less than 180 days, 180 or more, please show it as a separate disclosure. So additions, show it the deductions, and write a note that following income tax rules 1962 and section 32 for depreciation. Kindly write that, and you can follow the income tax method itself. But this is what is given. So intangible assets, I am just telling, there are a lot of intangibles. Brand, trademark, computer software, mining rights, masthead, copyright, patents, franchise, prototype. Only goodwill, no depreciation allowed. All the other item, income tax law allows depreciation. So a lot of people are having a misconception that there is no amortization or depreciation allowed in Income Tax Act for intangible. No, only for goodwill it is not allowed. Only for the word goodwill. Others are all allowed. So how do I know what is brand, what is trademark, what is patent, what is franchise? You can refer AS 26. There are definitions for these words, these intangible assets. There are definition how it is different from goodwill. For example, trademark is for a logo, brand is for a product. It is goodwill is for the entity as a whole, brand is for a product each. So products each make the whole entity. Brand, trademark, everything together only makes goodwill. But goodwill is arbitrarily arrived. But this is arrived for a particular product. It is attributable to a particular asset. That's the reason in income tax law they are having all these still. Goodwill is the only thing which they have removed. Capital work in progress and intangible asset under development. Opening additions less capitalized. Why am I lessing capitalized? It will go from development or work in progress to tangible asset or intangible asset under development. So this is what will happen. The next one. Investments. So investment, same thing, quoted, unquoted, permanent diminution. Because you are reading these words, by seeing, you automatically follow AS. For example, less provision for permanent diminution. So permanent diminution will be given for non-current investments. Why? Because there is a reason. In AS 13 they have told only for permanent diminution you need to reduce. Same thing is followed. So other investments, preference share, equity instruments, debentures, mutual fund, all these you will show it separately. Other investments, trade investments. So you have to give this Schedule 3 requirement. Market value at the end of the year you show in Schedule 3. Same thing should be shown here. Aggregate amount of quoted investments and market value thereof shall be quoted. Unquoted investment you need not show. If you show also fine. Provision for diminution that can be recorded. Details of so partnership firm, investments in partnership firm, given a footnote. What are the details of investment in partnership firm and name of partners in that firm? But rarely a non-corporate entity can invest in a partnership firm. Sometimes can be possible. HUF can, there are issues whether HUF can be a partner, but if an individual is having his own business, also he is a partner in another entity, this disclosure will come. This disclosure will 100% come. Is there in some firm? Also should be given. That partnership firm and what are the share of other partners. It's very useful. Why it is useful is, tomorrow income tax you have to show some assessment. All this I know. See this I have told this much interest I am having. All this is there in my balance sheet. So that can be shown. Then total capital of the firm is given. Then these are current investments. So here they have given what are the book value, number of face value, number of investments and book value. So the same thing is given here. Face value you can put per share or you can put the total face value. Say 1 lakh shares, face value 10 rupees, 10 lakhs you can directly write 10 lakhs. or you can write 10 rupees per share. I prefer writing 10 lakhs, whatever is the total face value, because it will be comparable with the book value. So current investments also the same classifications as non-current. But here it is trade value of lower of cost or market value, which is as per AS 13. So you see this disclosure, we automatically follow our accounting standards. Suppose you miss out something also, these disclosures and this financial statements help you to comply with accounting standards. Then the next one you have is loans and advances, capital advances, loans and advances to relative and partners of the firm, prepaid expenses, your advance tax or TDS net of thing. VAT and all they have given, VAT they have given, petrol entities have this, it is there for liquor, service tax credit, which still there in the balance sheet and you have still not received refund after 8 years. I don't know whether you will be getting refund, but you can still item GST, IT, security deposits and any other balance with any other government authorities. Then other non-current assets, expense you can show assets and other non-current assets. In inventories you class as raw material, work in progress, finished goods, stock in trade, stores and tools and other items. Trade receivables, for this staging is required, because here they have given less than 6 months and more than 6 months. SASHANK, why have they given this? Simply because banks drawing power computation, more than 6 months or more than 90 days debtors, generally they will not be considered in your drawing power computation. So at least the 6 months disclosure should be done here for the use of financial statement. So this is what is necessary. And again, you can write provision for doubtful debts, you can provide. Cash and cash equivalents, current account, cash credit account if it has debit balance, fixed deposits, deposits with original maturity less than cash and cash equivalents, cash in hand and cash in bank, bank deposits using the word cash. Earmark bank deposit. Earmark bank deposit, for guarantee I am giving some bank deposit. So all those bank deposits are earmark. More than 3 months and less than 12 months. That can be shown here. 12 months you can show it here or in short term investments. Then other but not due on deposit, and interest accrued and due on deposit shall be shown. I will just show the P&L, show the P&L notes, and we will be done. I would just bear with me. The next one we are having is our P&L. P&L is also the same as schedule 3 only. Revenue from operations, other income, total income, cost of goods sold, employee benefit expense, finance cost, depreciation and amortization. This has become ulta. There it is above, here it is below. So follow this format. Only this, follow this format. Other expenses, profit or loss before exceptional and extraordinary items, partner remuneration and tax. Then reduce exceptional items. Then you reduce extraordinary items. Extraordinary items will come in AS5. What are extraordinary items will be defined in AS5. Profit before partners remuneration. Here you show have it. From partners remuneration word need not be used. Then why? Because profit before remuneration only we check. If add a line, no problem. Partners interest you want to add a line, add and then put a separate line. Why? But then the partners interest should be shown. I will show where it is shown. Rather than here, it is shown in another. Another item in your finance cost, it will be shown. So partners remuneration, profit before tax, reduce your tax, current tax, deferred tax. So all this will be there. Any excess provision or short provision in the previous year, you can provide it as a separate line. It is not there in schedule 3. Here we have thought it out and this particular line is there. Suppose there is a short provision in the previous year. It happens. or there is an excess provision. When I did my tax audit report, I have to do it by 30th September. On that date 43B disallowance is there, I have to put extra provision, yes. Before 31st October it is corrected, there is still an extra provision. What to do with that? Next year you can put extra provision relating to previous year. There is a separate line for adjustment. Then discontinuing operations, you have a separate line. You have notes accompanying the same. So non-corporate, you see, huge thought processes. Donate for non-corporate entities also your charitable trust. So any donation or grant is also considered as revenue from operations. It is not other income, it is revenue from operations. So that is very, very clear here. Sale of service, same thing. From operation less, they've used the word excise duty, adjust GST also there. Any indirect tax, kindly adjust revenue from operation, dividend income, net gain, and other non-operating income. You have all these particular items. Then cost of goods sold, you can delete whatever is not applicable. They themselves. So cost of goods sold, raw material, opening, addition, end of the cost of raw packing material also this purchase of stock in trade, and then you have your changes in inventory. So inventory in beginning of the year, stock in trade, work in progress, finished goods. So all these put together will give you your cost of goods sold. This is different from your schedule 3. There is a small difference. In schedule 3 what you do is raw material consumed, you will be showing it as a separate line item. Purchases of stock in trade, you will show it as a separate line item. Changes in stock, you will show it as a separate line item. Here all put together, I am giving cost of goods sold. So one single note I am hitting it, and generally I personally prefer this. This is much better. This is much easier, much better. One note, full thing can be compared. Why? Because gross profit in your tax audit report you have to give in clause 40. Directly I can take my revenue from operations and less this, or else I have to reduce 3 lines from my P&L. So it saves me little bit time. So this is what is the small difference. I am just showing small differences between schedule 3 and this. Then salary, contribution to provident fund, contribution to ES separately, gratuity expense, staff welfare expense, finance cost. So interest expense other than partners and members capital. So on bank loan and finance lease you show interest. Partners interest you show it in finance cost. I am not comfortable showing here. You can show it in your face, but the guidance note shows it, tells to show it here. So kindly try to show it here, or else if you feel that is a better presentation, you can show it in the face of the P&L. Personal preference, showing it here. Other borrowing cost, loss on exchange transaction can be shown here. Profit will be shown in other income, loss is shown in finance cost. And then depreciation and amortization, you can refer your depreciation notes. And other expenses, you have consumption and stores and spares, power and fuel, repairs and maintenance, building, machinery. Because Income Tax Act, you have separate sections for each of this, 30, 31, 30, 31 you have. Insurance, rent, rates and taxes excluding taxes on income. So income tax provision, you show it in the face. So other taxes. So GST, generally GST, if you are not using input, you write it off with the same expense. You do not show here. Property tax, water tax, all this can be shown here. Labor charges, some repair with labor, you can show it here. Traveling expense, auditor's remuneration, printing and stationery. You can show it. So finance cost on sale, this is only for your Suppose you are getting foreign currency, external commercial borrowings that can be it here. It is better to do it here, diminish value. So these are the particular notes. So this can also be downloaded in the institute site. So all these are there in the institute site. All these are there. So the first thing what we saw today was the main thing before going to non-corporate entities, understanding non-corporate entities, we had to, seeing the financial statement, we had to see the accounting standards applicability. We saw what are the 4 types of entities. So level 1 is over 250 crores turnover, 10 to 50 is your borrowing, more than 50 crores is your borrowing. Then level 2 is 50 to 250 turnover, 10 to 50 borrowing. Level 3 is 1 to 10 borrowing and 10 to 50 your turnover. Level 4 is not covered under all the 3. Then we saw the accounting standards applicability, 27, 16, 12 and 8. So this was the applicability, fully applicable. 7 standards not applicable for level 2, 9 for level 3 and 11 for level 4, and there are certain disclosure exemptions. This we saw more or less like your schedule 3. Where small differences are there is, here MSME should be disclosed, there only MSE should be disclosed in trade payables. Here cost of goods sold comes in your P&L, there only the cost of raw material consumed, purchase of stock in trade and changes in stock. So that is what you have. Here you can write in other expense whatever you feel like. So there they have a particular format. Here you can write, this is just this what I shown is just a example. Here you can write whatever expense you want. Whatever expense which is related to the entities can be shown in this particular clause. Then we saw cash basis of accounting, they have a technical guide. Kindly go through that. So what all publications in institute should be gone through is guidance note on non-corporate entities. There is a separate publication for NPOs, audit and accounts of NPO. There is a separate publication, technical guide on cash basis of accounting. Also there is a technical guide for LLPs. LLP recording also kindly go through. So this all items please go through it so that you have an extensive understanding. Also, if there are some staff free at this point of time, some articles or somebody who is free and you are doing financial statement preparation, kindly, or you are free, or kindly at least do your 23-24 balance sheet and P&L right now in the old format. This publication had come in August 2023. Last year itself I would have suggested to do because comparison. So from this year we have to show it in a comparative format. What if I don't show it in a comparative format? It is your choice. The guidance note is very clear of showing it. It is very clear of showing it. It's not like a non-compliance of accounting standards, but if there is a guidance note, better to follow the guidance note. That is the only interpretation. If I don't want to put comparison, fine. But most of the entities will start putting comparison and following guidance note. Yes, sir.
But the guidance note also somewhere they change it is applicable only from 1st April
2024.
In that case, I can take the old format, I can...
You have to convert it. Yeah, you have to convert it. That's what I told. Now we are doing extra activity. Why I told last year itself for 23 to 24 to do it is, if I have done it last year, I just need to copy paste it here. Now I am doing for 2 years put together. And my old format to convert it to my new format. So this is what is there. So I thank all of you. Thank you all for being valuable listeners, listening till the end. And thank you all. If there are any doubts, you may please ask, no issues. And just sharing my contact for anybody who is needed. Anybody is having any doubts? So I think, yeah, yes sir.
My doubt, that is for charitable trust. For charitable trust, I will not do the accounting standard. Instead, I will make a working paper and I will state this accounting standard is not applicable. Because why I am saying this, suppose if I say it is commercial, then in that tax audit 10 BB, I am supposed to qualify that automatically tax will be computed. So the charitable trust will not be, no charitable trust will be interested in paying tax. So unless it is more than 50 crores, it becomes mandatory. Most of the charitable trust will be less than 50 crores only, the income. So I will state the accounting standard will not be applicable. Only thing is I will prepare the financials in the new format, and wherever applicable I'll just put a standard or notes or policy, whichever is applicable entity I'll make a note of it.
Anyway, we are doing cash basis of accounting for our charitable trust. So more or less, we will follow the technical guide more than the accounting standards as such. Because AS 15 and all, I need not do if I am doing, I mean, gratuity valuation, actuarial valuation, putting provision, leases provision, all this I need not put for charitable entity. I am following cash basis of accounting. So somewhere we can just write, we are doing cash basis of accounting, and I followed that, and that disclosure in the audit report is done more than enough. You don't even need to comment on the commercial industrial activity. So that is better perspective. Any other doubts? Yes, sir. Huh? Yes, figures can be, so there is given here, you can show it as full, or so here there is the classification. You can show it as full, or so here this yeah. So if your total income, word used is total income, and total income is not income tax total income, revenue from operations plus other income. If it is less than 100 crores, you can round off to the nearest hundreds, thousand, lakhs or millions thereof. 100 crores or more, you can round it off to this, or you can keep the full number. It is not an issue. If you round it off to the nearest hundreds, it's almost, if you put decimal, it will become the full number. So you can keep the full number, or you can show it here. You can round it off also. But why I prefer the full number is, anyway only one place you are submitting to your 3CB. You are attaching it with your 3CB and 3CD. No other place this particular line item is shown. Any other doubts?
This is not mandatory, like schedule 2.
No, this is not mandatory. Guidance note itself is more, since this is to do with accounting, it is more mandatory than recommendatory. Generally, guidance note on tax audit is recommendatory in nature. So if you see guidance note on tax audit, it is more recommendatory. It's the opinion of the institute. You can have a different opinion. But you have to tell where, what is guidance note is. It's a protective measure. For tax audit, suppose you are going beyond the guidance note, you have to write why you are going beyond the guidance note. In accounting, the problem is the statutory body which decides the accounting, not the problem, the benefit. The statutory body which decides the standards of accounting and audit, the only institute which can do is our ICAI. Nobody else can do it. So better to follow the guidance note for this. You can, if you are not following the nearest hundreds, you just write a note. Guidance note tells this, I have rounded it off. It's not a major non-compliance. No. Again I am telling you, this is because institute is the preliminary body which tells how to account, and the standardization of accounting and audit is done by the institute. So for accounting standards and audit standards, guidance note is more applicable. It is not like guidance note on tax audit. Guidance note on tax audit is more recommendatory. This would be more mandatory in nature. See, they have given a standardized format. I will simply tell, if everybody starts following guidance note, you also have to start following guidance note, because I have seen bankers, sir, that auditor is giving this way, you also give the certificate this way, you also give the financial statement this way. Practically, we turn it that way. We all turn it. And one more thing, we also have a standardized format. So schedule 3 is there. Also forget about this. Tally itself, if you classify the items correctly, your Tally or Zoho books or whatever, it automatically prepares schedule 3, right? There is no difficult job for me to convert it to this. That is what is mine, because Tally is being prepared. If the classification is proper, directly it does the schedule 3. They will tell you have not followed guidance note. That is why it's mandatory. That's what I'm trying to tell. Because tax audit also you can tell, okay, this is my interpretation of the income tax law. Because income tax law can be interpreted. But this is accounting aspect, ICAI is the main person. Any other doubts? So I thank all of you, and Jai Hind, thank you, Vande Matram. I am very happy. Thank you.
On behalf of SASC of ICA, I thank CA SASHANK SRIVATSAN for his broad coverage on applicability of accounting standards on non-corporate entities and detailing the cash base of accounting and guidance note on preparation of financial statement for non-corporate entity. Thanks for your valuable time in sharing your knowledge, sir. Now we'll go for a break, and second session will be continued by 2 o'clock. Thanks. For the second session on the TDS, TCS and Advance Taxes. So now I'd like to request the session speaker, CA MUTHUPALANIAPPAN sir, to come to the dais. CA MUTHUPALANIAPPAN is a fellow chartered accountant of ICAI with over 15 years of professional experience. He has extensive experience in direct taxation, transfer pricing and risk advisory services. Behind his professional practice, he regularly contributes articles, newsletters and alerts on the direct taxation and is sought after a faculty member of a direct tax in classes or professional courses. On behalf of SARC of ICA, I thank you for accepting our invitation and taking the time to be with us today, sir. As a token of appreciation, now I would like to invite CA Sugumaran sir to kindly present a memento to CA MUTHUPALANIAPPAN sir as a gesture of gratitude and love. Over to the session speaker.
Very good afternoon to one and all. Yeah, I hope the first session was very interactive and engaging. It's a pretty new topic because so far we have always been preparing a standard template financials only for set of people. Now the workload increases, right? So the role of chartered accountants never gets reduced. It's always an increasing platform. So basically there are a lot more to do, right? So for non-financial corporates also you have to maintain in a fixed format. It always looks good because there is a lot of transparency and other thing. But when you imagine the workload, of course it's a difficult task. The second session is something, again, is going to be something new that we'll be discussing, and it is going to be on TDS. Couple of things. Most of the time I'm always allotted the session which is post-lunch. We know how difficult it is to handle post-lunch sessions. So I know it is difficult for me and for you also. I'll try to keep it engaging, keep it interactive, keep it simple as much as possible so that we understand the transformation from what has happened in the Act, what is going to happen in the bill. So this transformation, we'll try to understand it in a most simplest way. And second thing, TDS is always, as the phrase goes, it's not my own phrase, TDS is always tedious. So that's a phrase that you would have heard generally whenever you hear about TDS, because there are a lot of sections, lot of provisions, lot of complications, so much of conditions, and add to that there are a lot of provisos, explanations, etc., etc. How many ever times you read that provision, you probably get a new meaning every time when you read. So that's the area that we are probably going to talk about it. So before we get into this topic, of course, it's first important to understand what is happening in the bill. Like, why do you need the bill, and how is the bill structured, and what exactly is the structure of this chapter that we'll be discussing. So these three elements that we'll be taking across. So the first is going to be the need for the bill, second is going to be the structure of the bill, and third is going to be the structure of the specific chapter that we are going to discuss. The need for the bill. Every act probably undergoes, the one which needs lots of amendments always undergoes changes. If you actually look at it, Income Tax Act was introduced in 1961. Every year Finance Act happens, sometimes couple of times it happens. So in the last 65 years, there are around 4,000 amendments that has taken place in this particular act. So imagine the volume. It was a very simple act which was introduced. Now there are around 4,000 amendments, which has made it more complicated, more bulky. So it's always a need for the new law. So that's what we are saying, that what has happened is the amendments has resulted in several areas which is putting us in a difficult situation. For instance, there are a lot of amendments, as we said. Language has become very complex. So when you read through the language, we know it's a law, but it could have been simpler. So that's what we generally feel. So the language is more complicated. And there are a lot of provisions. If you actually see, remember, you will probably read through the entire section. Last line will be, this provision is not applicable from assessment year 18-19. So probably you will have a line which says this provision is not at all applicable, which will be there at the end of the line, which makes the entire provision redundant or not any more applicable. So it makes us work complex to understand whether a particular provision is applicable or not applicable or something of that kind. So all these reasons needs for a new law. So what happened was, to make it conscious, this was the word of the finance minister when she introduced this, to make it conscious, lucid and easy to read and understand, we need to see whether it is actually the objective is achieved or not. So based on this objective, what has happened was, this bill is introduced. What is the effect of this? There are no provisos, no explanations. Looks simple, right? But they have introduced something called notes. So they have removed provisos and explanation. They have introduced something called notes to still explain a similar condition, similar situation. So that's what has happened. Okay, we look at it, how it has transformed. Of course, the entire act has tried to rationalize, redefine and revamp the entire act as a whole. So this is a table probably you would have seen across couple of times or several times, because this is an official release. I have just added the last 2 rows. Otherwise, it's official data, which they have said that there are around 47 chapters, which has reduced to 23. In fact, the last chapter number of the Income Tax Act is 23 only. The last income tax chapter right now is 23 only. But how is it 47? Of course, we play around with the ABCs. Across the act we play around. So it has made it 47. So in this 47, now they have simplified it. It's really 23. So the last number is 23. It's only 23 acts right now. So there are no more ABCs that are playing around. You all need to remember is the numbers that flow around this. So that's the simple thing. And of course, reduction of section, no more provisos, no more explanations. They have introduced lot of tables. We'll see the importance of tables, what all table can do in this chapter, particularly in this chapter we'll discuss. And there are also some formulas. We'll discuss one formula which is introduced for advanced tax calculation. So there are a lot of formulas that is introduced also to make it easier. So this is the overall thing. Of course, there are no major policy changes. And there are no tax rate changes, nothing has happened. So it's more or less the act, there is not much change, just the different words, different colors to the same act which we already know. But we have to remember new section numbers. So we would have just now got confident that we know some of the section numbers. Now we have to redo the entire exercise, so lot of exercise again. So all that has happened. So finally, they have removed all the redundant provisions. They have only retaining subclauses and clauses, subsections and clauses. There are no more provisos and explanations. And then there is extensive use of table and formula. So this is what has happened in the bill. So what has happened from act to bill is what this. So from this transformation, now our role is to understand one particular chapter. That is your chapter 19. So chapter 19 is the number in the bill, whereas in Income Tax Act, where we currently follow, it is chapter 17. So now as a prelude, as a beginning of this session, we'll try to understand how this chapter is structured from the act to the bill. How is it compared? So of course, in the act we have headings. Not only the chapters, we have several headings within the chapters also. So each of the heading is what we are discussing. So when you talk about this TDS chapter, that is 17 in the act, there are around 95 sections, which has now been brought to 41 sections. It's been reduced to 41 sections. And one area where this ABCs play around is TDS. You have 206 CCA. You don't even know why it is framed in such way. So you have such numbers here. So all that things. So you have a beginning of a very beginning introduction to the TDS provision. And then of course you have the list of TDS from 192 to 206 AA. All of them are covering about tax deduction alone. And then of course you have tax collection, which only has 4 provisions, 206C to 206CC, which is all the TCS provisions are listed in one section. There are not multiple sections like TDS. All the TCS is listed in one section, that is your 206C. It is not listed anywhere else. And then you have collection and recovery, advance payment, which has around 11 sections, which talks about how to compute, what percentage to compute, for what not to compute. All that is discussed in 11 different sections. All that remains identical in the bill also. Collection and recovery has around 13 sections, which is all about your tax recovery officer, the jurisdiction, and how it is collected, how it is freezed, and all those things are discussed. The interest, of course, common things that we work around, 234A to 234D. All the 4 sections relating to calculation of interest is also covered as a separate chapter heading. And last one is late fees, that is your 234E, F, G, H. All the 4 sections which are covered in the last heading. Now, how has bill transformed? They have just left out the BB, so there is no more BB, you only have B, which is your A is general, B is deduction collections. See the number of sections, it's only 11. From what? From 61 sections. From 61 sections, the TDS and TCS has reduced to how many sections? 11. Does that mean they have removed any TDS provisions? No. They've just combined everything, compiled everything into one single section. So when we look at the number, it looks very interesting. 60 sections have become 14 sections. How interesting it is. But nothing has changed. The entire 60 is into that 14. We'll see how it has gone into that 14 sections. We'll understand that. So that is what is about your deduction and collection. Rest all, if you see advance payment, collection, recovery, the interest, everything more or less remains same. So the transformation has actually happened in TDS and TCS thing. In fact, if you have to say, it has lot of combinations has happened in TDS from close to your 57 sections. It has come down drastically. So that is the change that we are going to see. Now this chapter, today we will be discussing 3 areas. That is your TDS, TCS and Advance Tax. So these 3 topics is what we will be discussing today. We have section from 390 to 410 is what we will discuss. Interestingly, the first section number of TDS in chapter 17 in the current act is 190. 190 is now 390. So 190 has just become 390. Other numbers doesn't match. So 190 has become 390. Rest all, maybe for salary, 192 has become 392. Rest all remains same. Rest all remains different. It's not the same. So these are all the sections that has been introduced. How many sections for tax deduction alone? Discussion of TDS. 2 sections, 392 and 393. 392 talks about salary and PF withdrawal. 393 talks about all the other TDS deductions, which means right from your 193 to your 196D, all the TDS provisions that you are talking about is now combined into one single section, that is your 393. So how have they done that? Of course, it's going to be bulky, right? All that put into one single section, but they have tried to make it as simple as possible, to make sure that it's easy to understand for anyone without a chartered accountant's help. So probably someone can read and understand. That's the intention. As I told you, we need to see how far the objective is being achieved. So this is the structure. This is the structure of the chapter 19, which we will be discussing today. Of course, there is a straightforward comparison of each section supported by the department itself. They themselves have released a handbook of saying how section matches with each of the relevant provisions in the bill. So how does that match? So if you actually look at it, most of the sections, all the sections has a number called 393, because I told you the entire TDS has been cruxed into one single section, 393. So the reference is simple. Whichever section you are talking about, 194C, what is the relevant section? 393. So there is no change. 194J, what is the relevant section? 393. There is no change. For every section, you are going to tell what number? 393 for all the TDS sections. 195, non-resident, still 393. You need not worry about whether it is a non-resident, whether it is a resident, or any of the category of persons you are talking about. What is the section number in the new bill? 393. There is nothing else. Now, how have they differentiated? The table numbers. serial number 5, serial number 6. So what we have to remember as chartered accountants is not anymore the 192 or 194. We have to remember which serial number. So that's the change that has brought. So we need to remember which serial number, which table that it belongs to. So these are the things, each of them. If you actually look at it, everything has 393. Just the subsection 1, 2, 3, 4 keeps changing. We'll discuss about when it is 1, when it is 2, when it is 3, when it is 4. There are clear segmenting this data, so it's very simple to understand. 1, 2, 3, 4 is all that you need to know under section 393. So the goes on for all the sections. It's only 393. As I told you, it's only 1, 2, 3, 4 changes, and the table changes. Every subsection has only one table. 393 1 will have one table. 393 2 will have one table. We'll discuss about that. So that is the structure we are talking about. And then if you move on, probably even in this section, it's all about your tedious section, so nothing changes. Then you move on from 197, you move on to other sections, that is your other complaint sections, which is discussed from 395. So it talks about other sections. 393 is for TDS, 394 is for TCS, and 395, from 395 it's administrative. What are all the procedural things that needs to be discussed is discussed from 395. So that's what it is about. And interestingly, like any idea on what is section 43 in your Income Tax Act, section 43? Generally, all the definitions are listed in which section? All the definitions of Income Tax Act, section 2. Like most other acts, all the definitions are listed in section 2. Now, but does that mean every definition for the purpose of income tax is only reported in that section? It can't be, because there will be a lot of other elements for which you need different explanations. Probably you need the definition only for that chapter or that section. So probably you need definitions then and there. So sometimes for each head of income, might be you will have a section. For example, all the definitions relating to PGBP is discussed in section 43. All the definitions relating to transfer pricing is discussed in section 92F. So every chapter, wherever it requires a separate definition or a separate introduction, they have introduced a section in the old act, apart from section 2. Then of course you will have definition under the explanation. You will have explanation where it would have defined what is work contract, who is a specified person, all that will be defined where? In your explanation. So in Income Tax Act, either a definition will be there in section 2, or it will be there in that subsections or that sections allotted exclusively for definitions, or under explanation. This is how Income Tax Act is structured. Now what is bill trying to do? It is trying to introduce one specific section under each chapter or most of the chapters exclusively for defining the terms. They are calling this, since everything is changing, they are calling the definition section as interpretation. Because not necessarily you are defining there, you might also be clarifying. You are trying to explain what the term means. So all that, for example, if you talk about 194 IA, consideration for immovable property. No one is defining what consideration for an immovable property is. They are trying to explain you what should be considered as consideration for immovable property. So it's more of an explanation rather than a definition. So that is also combined in this 402. In your new bill, it is section 402. So under 402, you have all the definitions or interpretations or explanations which are required for this chapter alone, chapter 19 alone. It is not a common thing. So that is one interesting section. Of course, we'll discuss how it works. So some of the sections, if you actually look at it, person responsible for paying, currently it is 204. It is defined in 402 subsection 27. So subsection 27 explains you what refers to, or the clause 27 refers to what means by the person responsible for paying. So that's how 402 is, instead of defining then and there, they have explained it in one single section. So that is the advantage of 402. And then how has TCS transformed? All your 206C, all your provisions under section 206C is now transformed into one single section. What section? 394. So it's the same. Earlier it was in 206C, now it is in 394. But what has changed? We'll see that You need not remember 1C, 1D, 1H, 1F. You need not remember that. You just need to remember 1, 2, 3, 4, 5, 6, 7, 8, 9. So there are 9 characterization which has been given as a replacement of 206C, which will be your new 394. New 394, which will talk about tax collection at source. One single section which will talk about it. Then other things, for example, 206CA, which talks about your tax collection account number, is also discussed here in 203A. Tax deduction and collection account number, which is 397.1, which means it has combined. Why do you need a separate provision, once for TDS, once for TCS? So all common provisions like 197 talks about what? Your lower deduction certificate for TDS. Now that is also combined. There is no two different provisions for TCS and TDS. It is combined into one single provision. So that is what is the, if you look at it, 395.1. Now 395 is common for both tax deduction low rate certificate, tax collection low rate certificate. Both are discussed under one single section. So that is also transformed here. And advance tax, of course, it remains the same, not much changes. Only thing, one provision has been split into two. So far we have been talking about combining. There is one scenario where it has been split. So 210, which talks about calculation of advance tax. The first subsection of 210 talks about calculation of advance tax by the assessee. Assessee themselves needs to calculate the advance tax. The rest of the section of 210 talks about how an assessing officer concludes or calculates the advance tax. But now it has been split into two. 406 is for assessee, 407 is for assessing officer. So it has been split now into two sections instead of one single sections. So these are all the changes that has been mapped from the old act to the new bill. Of course, it's important for us to understand how it is transforming. Some of the provisions which are redundant, as I told you, you read through the act, finally you realize that section is not at all applicable. It has been completely omitted from a particular point in time. So such provisions has been redundant. So these are the provisions that are removed. So for example, 206 is not applicable from 1st April 2005, because this was only applicable for TDS returns before 1st April 2005. So that is no more applicable. So that is now removed. Of course, now currently based on the last 2 years amendment, you can only revise TDS returns for last 6 years, only for last 6 years. So you cannot revise beyond that. So now they have removed that 1st April 2005. And rest of the thing which was not applicable from 1989, 1st April 1989, so which was still there as a section that remained in the act, now that is also removed. So all the old thing, as I told you, whichever is not required, no more applicable. You need not unnecessarily add on to the weightage. They have completely removed it. Okay. Now, with all this setup, 393 as 1, 394 as 1, all these numbers alone, no ABCD, no ABCDs, nothing. So will that continue forever? Can that be maintained forever? Because probably when the act was initially introduced, that would have been the intention or something. But then only due to a need for bringing into the same section, same chapter, same heading, you would have added A, B, A, C, all that would have happened. So will that happen here also? Probably not, because they are going to add within the same section. Within 393 itself, they will keep adding, and they are not going to follow any chronological order or alphabetical order. So because definitions is currently defined in alphabetical order, whenever there is going to be a new definition, it's going to be added at the end, not in between. Because only when it is added in between, it is going to disturb the numbers. You need to bring in A, B, C. Now it's no more required, because no more, it may not remain alphabetical. Generally definitions will remain alphabetical, will have a sequence. Now I don't think it will have anymore, because whenever there is in future, when new definitions or something are introduced, it will not fall into that middle, it will fall into the end. So that will be the intention of this introduction. Okay, we'll take one simple section to see. Very first section we'll try to understand how it has been simplified. We call it as charging section. One section has to tell that TDS can be deducted by a particular person. So that charging section for TDS chapter 17 in the act and 19 in the bill is 190 in the Act and 390 in the bill. So what does 190 talks about? 190 says, is it readable from the end? Okay, thanks. So it is basically, let's take the first stanza on, notwithstanding that the regular assessment in respect of any income is to be made in a later assessment year. This is to say, irrespective of when your income is assessed, TDS applicability arises in the relevant year, in the relevant previous year, in as per the old 190. Now, of course, previous year has become what term now? Previous year has become tax year. So it has been changed as tax year. So this tax year is what is relevant. So how have they formed it now? They have actually formed it to say that nothing contained in the section, remember C393, nothing contained in the section shall affect the change of tax on such income under section 4.1. And read 2, tax referred in subsection 1 shall be payable as per provisions of this chapter, irrespective of the assessment to be made later than the relevant tax year. So which means the first clause of that 190 has been moved into 2 because the word notwithstanding has been completely removed in the bill. Whenever the word notwithstanding is used, it's called as what clause? Non-abstent clause, which means it doesn't affect anything else. This stands before every other provision. So moment the word notwithstanding is used, it overtakes everything else. So now that notwithstanding has been removed across the bill. Instead, they have used the word irrespective. Wherever we see the word notwithstanding as a non-abstent clause, this bill has used the word irrespective of anything else. It is chargeable now, it is chargeable here, it is chargeable under this clause. So that's a shift. So that's what has happened here. So they now introduce separate subsection 2 to say that this income has to be taxed in the relevant year, deducted in the relevant year, irrespective of assessment is happening later point in time. So they have just rephrased the section. And the tax on such income shall be payable by deduction is what the number 1. Tax on income shall be payable by this chapter as 3 different sections, A, B, C, which is your TDS, and then your advance tax, and then your non-monetary perquisites under salary. So these are the 3 modes that are discussed under section 190 and 390. Nothing has changed, everything remains here. If you read here, the tax on such income shall be payable by deduction or collection at source, advance payment, by payment under section subsection 1A of 192. So nothing has changed. Everything has been rephrased into this section, but they have put it like a bullet points, like as you write a notes, they have put it like a bullet points. And then one thing that this bill has done is tried to bring in logical flow, because once you are trying to read something, the relevant provisions has to come within there itself. For instance, in salary, what change has been made is, initially if you need to understand gratuity taxability arises in salary chapter under section 15. But if you wanted to calculate gratuity, you have to go to section 10 clause 10. Only then you can understand how much of gratuity is taxable, how much of gratuity is exempt. Then what happens here is, so gratuity, to understand gratuity, you are jumping from salary chapter, you are going to exempt income chapter. But where does that gratuity belong? It belongs to salary chapter. So this jump is unnecessary. It could have been defined or it could have been explained in the chapter of salary itself. So what they have tried to do in chapter 19 also, bring the sections together, bring it into common portfolio. So for instance, take this section 202 of the Act, which specifically talks about that TDS is one of the mode of tax collection, not the only mode of tax collection. So this is discussed in section 202. So when you have to collect tax, TDS is not the only model, it is one of the models. So this is being highlighted in section 202. But when you are talking about deduction in 190, why explain this in 202? Both are similar concepts. You need to highlight it in the same under the same concept. Why do you have to define it in a different places? So what has been done here is, now they have brought it into the same category. So it has been brought into 202. Then section 199. 199 talks about moment someone is paying TDS, who has to take credit, how it can be taken credit, all this credit aspect. So if someone is deducting TDS for me on the audit fees, that whatever has been deducted is my tax paid. Whatever is my tax paid. This concept was discussed in 199, where they said the credit will come to me because it is my tax. Now this is also related to what? Related to the topic of deduction, the base concept of deduction. So now this is also brought into. So section 390 is a combination of 190, 199, 202. All these three put together is what? 390. Why? Now 390 talks about tax deduction, talks about the mode of recovery, talks about how to give the credit. All of this concept is discussed in one single place, one single section. Whereas in the Income Tax Act, how have we seen? We have seen it as three different sections, three different scenarios. You understand the difference, how it has changed or how it is moving. So they are combining common concepts, logically grouping multiple provisions into one single sections. So this has been the highlight of this bill, one of the highlight of this bill, where they have tried to group and bring it together. You can stop me whenever you wanted to discuss or ask me something or develop a discussion on a particular point also. That also would be helpful, because most of us will be on the same page rather than me completely, unless apart from the bill, probably other things you might have your own experience. So you can always stop me, share your views, or let me know if there are any queries on the topic also, so that let's not keep pushing without ensuring that all of us have understood here. Any doubts, any discussion, something? So far on the structure or something you have any doubt? I have explained. So far I have just touched upon the basic. What basic? How is it structured? How is it flowing? How the act is actually flowing into different parameters. So that is what we are understanding. So the law is rewritten in this manner. This is what has been done across the sections. Of course, we'll see a lot more deeper understanding of this. So before we get into the specific bill provisions in comparing, I wanted to just go a little step further and ensure that we all are aware of the recent updates in the last 2 years of TDS provisions. We will not go beyond that, because TDS provision is one section where it keeps regularly changing. Every year it's changing. And I always feel from the government's perspective, TDS is a provision which is introduced whenever government feels there is a gap in recognition of revenue. Whenever there is a gap in recognition of revenue. We'll take our own case. Chartered accountant firms, or any firms for that matter, issuing partnership remuneration. There is no TDS till 31st March 2025. But TDS has been introduced under section 194T from 1st April 2025. So what is the need? Because government has noticed that there is not much of mapping between the partners declaring the remuneration and the companies or the firms declaring their remuneration. So to bring this map, to bridge this gap, they have introduced a provision 194T, where from 1st April 2025, whenever there is a remuneration paid to a partner, that is, when I say remuneration, any mode paid to a partner is subject to TDS deductions from 1st April 2025 at the rate of 10%. Sometimes I feel the rate could have been kept lower. Instead of 10, it could have been kept lower. But of course, probably they have aligned with the technical services, because whatever a partner of a firm is doing probably could be aligned with the technical or professional services. So they have combined with 194J to bring in with 10%. So that is something, one of situation. Another situation where this gap was plugged by the government was a very interesting concept of benefit or perquisites to business people. Salary perquisites is very clear. Whenever there is a car given, or a housing accommodation given, or any other facility, loan, education, medical, whatever facility you are talking about, given to an employee, of course undergoes your regular tax deduction under section 192, the new 392 which will be in place. So this has been there already. But what about the perquisites under business? Section 28 clause 5A of the existing act tells you that any benefit or perquisite is a taxable income, is a business income under the chapter, under the heading business or profession. So now this 28 5A, just imagine how will this work. Probably if I am a FMCG manufacturer, I will have plenty of distributors To promote more sales, I will give rewards. What kind of rewards I'll give? I'll give a trip to Sri Lanka, Singapore, Thailand, or I'll give some car, bike to the highest selling distributor in the region, in the state or something. Now, whatever I'm giving as an FMCG manufacturer, I will claim it as an expenditure, a promotion expenditure, or a sales expenditure, selling expenditure. I will create it in my books of account as expenditure. But you tell me, will a person who has received that car or the bike or the trip, he should actually declare what? He should actually declare income. But will he declare or not is a very big question. Probably my straight answer would be no. Most of the cases. Very rarely probably someone would come up and say that I will report this. So there was a big gap, huge gap in this reporting. There are a lot of rewards, selling expenditure or marketing expenditure distributed as an income to another person. So automatically what government did was they introduced 194R. They introduced 194R saying that TDS is applicable on perquisites at 10% on that perquisite that you are giving. So this was also introduced to plug the gap. So TDS is one provision where government introduces whenever they wants to plug the gap of that. So it is important to see that it keeps updating, amending, so on and forth, so that it is important. So we'll understand what has happened in the last 2 years with respect to these amendments, because the income tax bill is based on the finance bill 2025. It is based on the finance bill 2025. So that is the state of income tax bill. So it is important for us to understand these two elements. So very simple changes, or in some of the simple changes in section 193, which talks about interest on securities. So your debentures and bonds. So one of the bonds were additionally introduced. That was your taxable savings bond in the year 2020. The old one was 2003 and 2018. 2020 was introduced. So no TDS on interest on this bond up to 10,000. Up to 10,000 there is no TDS. So this was amended in 193. What about 194? It's for deemed dividend. There is a very subtle change in this deemed dividend, because deemed dividend actually derives the definition from section 2 clause 22. Section 2 clause 22 defines what a dividend is. So dividend is generally, if you ask any person, if you ask what a dividend is, probably someone will tell you that it is a distribution of profits. If you go and ask probably a person who is into comparing company secretary and other things, probably they'll give you a little detail about how this distribution happen, other thing. But income tax goes a step further, like no one can imagine what the definition of dividend is. They talk about liquidation, they talk about issue of debentures to equity shareholders, they talk about buyback of shares, they talk about reduction in share capital. All of this is discussed. This buyback, that word I used, was introduced only from 1st April, this Finance Act 2024. So what does this buyback talks about? As of before this Finance Act 2024 was introduced, buyback is taxable in the hands of the company, the domestic company. Domestic company which is buying back the shares needs to pay tax under section 115 QA. 115 QA is applicable for buyback of shares. It was not taxable in the hands of shareholder, it was taxable in the hands of the company in case of domestic company shares. Now, what has government done in Finance Act 2024? Now they are moving the taxability from the company to the shareholder. So shareholder has to treat it as dividend. Whenever a company buys back the share, the entire amount which was settled for buying back the shares is taxable as dividend under section 56(2). So this dividend will be taxed. Okay, what happens to my cost? I would have paid something to buy that shares. Government says you can declare it as a capital loss under section 45. It is your capital gain loss. It could be a long term or a short term, but it is a capital gain loss. So declare the loss under capital gain, declare the income under income from other sources, and this is called as dividend income. Now TDS is applicable on this also. So that is why they have also including F now, clause F. Earlier it was 5, now they are including one more to say F is also applicable. So that is something that introduced. 194C, there has been a couple of items introduced, calling it as not works contract, 194C is applicable only on works contract. Couple of things are introduced now. What is the couple of things? One is very simple. If it is already covered under 194J, then it is not covered under 194C. So that is a very simple thing that was introduced. The another thing was already there. They have just made it very clear this time. The particular activity is, let's say I am a manufacturer of a particular product, but that product, the design of that product, materials for that product, both are given to me from my supplier. So whoever wants that, from my customer. So whoever wants it is giving the design, is also giving me the material. This is according to 194C, this is works contract. It is a works contract. But what they say is, if you have received the material not from that person, not from your customer or customers related party, not from customer, not from customers related party. Who is a related party? Which is defined under section 48(2)(b), which discusses about the relationship. So if you are not a related party or that particular person, then it is not works contract. So which means I need to manufacture for someone, they are giving me the design, they are not giving me the material, I am buying material from some third persons and I am manufacturing. This is not works contract. This has been clarified. This has been clarified in Finance Act 2024. So that is a change in 194C. And several sections, wherever they saw the number 5, they reduced it to number 2. I should not say wherever, still there are some sections. Most of the sections, wherever it was 5%, it is now reduced to 2%. What are those sections? 194DA, which is your LIC insurance receipt. For any LIC policies that has been taken, LIC policies are exempt. LIC policies are exempt, or life insurance policies are exempt under section 10(10)(d). So 10(10)(d) provides exemption for LIC policy. Now, policies which are not exempt, under section 10(10)(d) is subject to tax deduction. It's subject to taxability. So that tax deduction is discussed in section 194DA. It was 5%. From 1st October 2024, it has become 2%. It has become 2%. So that is one change. And then 194G and H, both are commissions. G is what commission? Commission on lottery tickets. H is general commission. Any other commission is discussed in H. So both of them 5 to 2. 194IB and 194M. Both these sections, IB I think you would be familiar. What is 194IB? Which is rental for a normal individual. That is an individual who is not covered under 194I. When you say 194I, it is rentals, right? Rental payments for whom? Who must make to whom? Rental payments by non-individuals or individuals whose business turnover is more than 1 crore, profession receipts more than 50 lakhs. For them only it is applicable. Which provision? 194I is applicable. So for them 194I gets attracted. So individuals who has a business turnover more than 1 crore or professional receipts more than 50 lakh are already covered under 194I. Other individuals in HUF are covered under which section? 194IB. So where your monthly rental is 50,000 or more, so then it is applicable, your TDS, which was at 5%. Now that is also reduced to 2%, 194IB. 194M is also for similar category, that is individual who are not covered under 194C, 194H, 194J. All of them are nothing but which individuals? Whose business turnover is not more than 1 crore, whose professional receipts is not more than 50 lakhs. So such individuals are if they are spending for any contract work, any professional work, any commission work, it gets attracted. Which section gets attracted? 194M gets attracted. For how much? If you are paying more than 50 lakhs, 50. In a year, if you are paying more than 50 lakhs, you must deduct 5%. Now it has become how much? 2% from 1st October 2024. So these are all the shifts that has brought in from 1st October 2024. One section has been omitted, which is 194F, which was specifically for repurchase of mutual fund and unit trust of India. Very old mutual funds or UTI units, where the 194F was applicable. Those units are no more sold or purchased, so it has been scrapped. So 194F is no more applicable. 194IA, all of us know it is relating to sale of immovable property. It is applicable when the property value crosses 50 lakhs. And that 50 lakhs, there is always this confusion, should we check per buyer, per seller, or total? So that is what there. In fact, the Act says, 194IA uses the word, when the aggregate consideration or the stamp duty value, whichever is higher, is more than 50 lakhs, only then this provision is applicable. So it kind of already informs. What does it inform? Aggregate consideration, it informs stamp duty value. So which it already informs that it is applicable for the total property, not per buyer, not per seller. But there are some people who are misinterpreting and not detecting, saying that Act never explains. Act is not clearly clarifying whether it should be treated as per buyer or per seller. So it has to be accordingly considered. Now to clear this, they have introduced a proviso. What have they introduced? It is irrelevant. Number of buyer, number of seller is irrelevant. If the total consideration is more than 50 lakhs or the stamp duty value is more than 50 lakhs, 194IA is automatically applicable. 194IA is automatically applicable. So now this has been introduced as what? First proviso, which means it's not a clarification. Provisos are always prospective, is not retrospective. Only explanation and clarification in the Act. Whenever there is an explanation or whenever there is a clarification provided, it is considered to be retrospective. It is not considered to be prospective. But now this has been introduced as first proviso, not as a clarification, which means we can argue that till 30th September 2024, it is per buyer, per seller. It is not complete. We can argue, but from 1st October 2024 only, what has been brought into the picture? First proviso. So this was introduced also in Finance Act 2024. 194O, any idea on O? It is about online trading. So whenever this, for example, I think all of us know, when you buy from Amazon or Flipkart or any of the providers or anyone, are you buying from them or from someone else? From someone else. So whenever there is a transaction between that market aggregator, that is Amazon or like someone like Amazon, settling the money to whom? To the actual seller, the real seller. We buy it from Amazon, but we don't actually buy it from Amazon, we buy it from another seller. Now whatever money has to be settled, I settle to whom? I settle to Amazon. Now Amazon has to settle it to that seller. Now this settlement between Amazon and this seller, now this is covered under 194O. So whenever there is an amount more than 5 lakhs, TDS is applicable at 1%. Now this is reduced to what? 0.1%. So that is also a change. 197, now lower reduction can also be applied for 194Q. What is 194Q? Purchase of goods. So whenever you are purchasing goods for more than 50 lakhs, TDS is applicable at 0.1%. Before 1st October 2024, lower deduction certificate cannot be obtained for this because the rate itself is already how much? 0.1%. So there was no such provision, but many of the people complain saying that I am a loss making entity. Even that 0.1% will hit my cash flow. So something has to be done for this. So government heard that and said that now everyone can apply, like 194Q also can be applied for a lower deduction, considering that you don't want that 0.1% also. 206C1F, it was only for car sales. Whenever a car is sold for value more than 10 lakhs, TCS is applicable. Now from 1st January 2025, they have extended it to notified goods. Now on 22nd April 2025, it was also notified. What are the products notified? Wristwatch, RPs, all these 10 items which are listed here, Now each of this item, each of the transaction, if it exceeds 10 lakhs, each of the transaction, if it exceeds 10 lakhs, TCS is applicable on this. Remember, not combined aggregate, nothing, each transaction. If I am buying 3 cars, for every car I have to check whether it is crossing 10 lakhs. There is no aggregate in this provision. So I have to check whether each of the transaction is crossing 10 lakhs. Accordingly, the 27 EQ is also modified. The TCS written, that is also modified. That is also modified to include your related these items. They have listed out all these items to report under 27 EQ. That is also amended. This TCS is applicable from 22nd April 2025 only, not before that. So even though the notified date was 1st January, this provision is applicable only from 22nd April. So it is only applicable from this quarter. What happened in I'll talk about this. Finance Act 2025. What are the changes in Finance Act 2025? In FA 2024, we noticed that lot of sections underwent a rate reduction from 5 to 2. In Finance Act 2025, lot of sections underwent a upgrade to the threshold limit, an increase in the threshold limit. So this change happened. So 193 for debenture for companies, it has increased from 5 to 10,000. For individuals, there was no limit. Now 10,000 has been brought in. So now there is a blanket limit for all the cases in 193 at 10,000. Dividend is doubled. Interest for senior citizen from bank deposit is also double. 50,000 has become 1 lakh. For others, 40,000 has become 50,000. Winning from games. This as actually 194B and BB. B talks about games. BB talks about horse races. So these are the two sections. Earlier, prior to Finance Act 2024, the section just read, if it crosses 10,000, TDS is applicable. Tax must be deducted on an amount exceeding 10,000. So the question came out, is the 10,000 for single transaction or total transactions? So many of them assumed it is single transactions. So government clarified in Finance Act 2023, they clarified that it is aggregate and not a single transaction. So they said it is not single, it is aggregate. Again in Finance Act 2025, now they have clarified it's not aggregate, it is single only. Why this confusion? Moment the concept of aggregate was introduced, remember I am winning games. I am winning 3-4 different games. Each of them are paying me money. Now according to this rule, I have to tell the other person that I have already got a winning. How far I will actually truly convey this information that I have collected number, I will not convey or I may not convey. So to support this, there is a confusion in sharing of information. Me telling others that I have already won. So please deduct TDS. I may not come out voluntarily and convey this information. So automatically what they did was, they have now introduced a single transactions for every transaction. For all the commissions, insurance, lottery tickets, general, for everything, the limit has been enhanced from 15,000 to 20,000. So that's also a change. For rental, there was a big change in 194I, where in 194I probably the limit was 2,40,000 per annum, combined for what and what? Combined for plant and machinery and building. It is a combined limit. So if it is together exceeding 2.4 lakhs, TDS was applicable for both plant, machinery, equipment and land and building. Put together, if it is crossing 2.4 lakhs, TDS is applicable. 2% on plant and machinery, 10% on your land and building. So this is what was applicable. So now this limit has been enhanced to 50,000 per month. Do you remember this number elsewhere? 50,000 per month. IB. So IB also has the same number. So now the limit is common for both the rentals, be it the specified persons or be it your regular individuals HUF. For everyone, rental TDS is applicable when the limit crosses 50,000. What is the difference? Under 194I, what is covered is not only land and building, it also includes plant, machinery, equipments. Whereas when you talk about 194IB, IB only has what? Only has your land and building alone. It doesn't have anything else. And the rate differs. That is 10% and 2%. Here it is flat 2%. For land and building, 194 IB has 2%, whereas 194 I has 10%. So that's the thing. So now they have bought it as 50,000 per month. So it is per month. So for any of the month, if you are not paying 50,000, it's a less rental, TDS is not applicable. TDS is applicable only when your rental exceeds 50,000 in that month. It is monthly basis. So every month it is applicable only when it crosses 50,000. But during the speech, it was announced as 6 lakhs. During the speech, the word used by the finance minister was 6 lakhs, but ideally the provision talks what? 50,000 per month. It is not 6 lakhs. So, moment it crosses 50,000 in a month, TDS under 194I is applicable. Next, professional technical fees. Section, it was 30,000, now increased to 50,000. Now, what is unique in 194G? Is this 30,000 a straightforward number or something else? 194J, is the 30,000 a straightforward number like we are talking about for rental and other thing, or is that something else? For reimbursements, yeah, we'll discuss about it. The aggregate, usually there are 5 clauses in 194J. 5 clauses in 194J. First one is professional services. Number 2 is technical services. Number 3 is managerial remuneration, which includes all reimbursements, everything to the managerial remuneration. Number 4 is royalty. Number 5 is specific nature discussed in business income, which is about not sharing private information, not disclosing, refraining from not doing anything. That is, you are not sharing an information, someone is giving you money for that. So, for example, I have created something, a software or something, someone is purchasing from me, they are giving me extra money. For what? For not sharing the secret code to someone else. So, that is also business income that is covered under 194J. So, that is called as refraining from doing something. Refraining from doing something. Tamil solna chumma irukradhukku. So you have to be idle. So for that they will give you some money, for which it is covered under 194J. So this 194J, the unique feature of this 194J is this 30,000 is not overall limit, it is independent. 30,000 for profession, 30,000 for technical fees, 30,000 for royalty, 30,000 for refraining activity, 0 for managerial remuneration, 0 for managerial remuneration. So this is the different unique concept in 194J. So that is what discussed in 194J. Now that 30,000 has become what? 50,000. That 30,000 has become 50,000. So now it is 50,000 for professional service, 50,000 for technical service, 50,000 for royalty, 50,000 for refraining activity, 0 for managerial remuneration. So that is the shift that has happened in 194J in the Finance Act 2025. Mutual fund units, similar to dividend, it has doubled 5,000 to 10,000. Any compulsory acquisition, the limit was SR. Yes, sir. No, what, sir? Yes, sir. What they have done is, in the Act, when they are explaining the limit, they would have said 50,000 for Class A, 50,000 for Class B, 50,000 for Class C, 50,000 for Class D. BA would have been left out in that. BA represents managerial remuneration. So there are independent lines listed in the threshold limit in the 194J, where it would represent A, B, C, D. There is an in-between number BA which would not have been specified in the section in the 194J. So and that's how it is drawn as no limit for managerial remuneration, including your sitting fees, everything. Sorry, sir? Correct, sir. You have to deduct TDS. So it includes for sitting fees, it includes for remuneration. Whatever is paid to the managerial category is automatically covered under this section at 10%. So there are a couple of rates here, 2% and 10%. For managerial remuneration, it is 10%. There are only 3 situations where it is 2%. First situation is technical services, not professional nature. Technical services, not professional nature. What does that mean? Provided by a person not listed as professional, who Who are called professionals? Section 44AA defines who are called professionals: auditor, lawyer, engineer, doctor. In fact, it's not auditor, it's accountant, engineer, lawyer, doctor, interior decorator, architect. So there are several professions, and there are some notified professionals like your information technology, IT professionals, company secretary. These are all notified. 194J has additionally notified few more: sports person, umpires, referees, coaches, physiotherapists. All of them are also called as professionals. So if a service is provided by these persons, then it is 10%. If any other technical services is provided other than these persons, then it is covered under 2%. So that is first. Second is royalty for film making, cinematographic film. So royalty is paid for cinematographic film. It is not 10, it is 2%. Second one. Third one, for any BPOs and call centers. Any BPOs and call center, it is not 10, it is 2. For these three situations, it is 2% and not 10%. For everything else, it is 10%. So like managerial remuneration also will be subject to 10%. So that is the categorization of the rate. So it is one of the unique section which defines differently. The limit is defined differently. The rate is defined differently. For instance, if you take 194C, it's very simple. Individual's HUF is to 1%. Every other person is 2%. It's straightforward. But 194J goes into the nature of service. Based on that, rate is categorized. So in last one, yeah, we have compulsory acquisition of immovable property. So when you say compulsory acquisition of immovable property, it basically refers to when a property has been, like all these metro work acquisition, when government is compulsory acquiring. Earlier the TDS was applicable when it crosses 2.5 lakhs, 2,50,000, but now it has been increased to 5 lakhs. It has been increased to 5 lakhs. So that's the quantum of increase that we're talking about. And here also it is 10% on the entire consideration. And this section specifically says it could be a consideration, it could be an enhanced consideration, it could be a compensation, it could be an enhanced compensation. So they are referring to all three elements, all four. So it could be regular or enhanced also. For all of them, 194 LA is applicable at 10% when the income exceeds 5 lakhs instead of 2.5 lakhs. Any doubts in any of these amendments? Yeah, but the 194 LA says compensation or enhanced compensation. So it includes for both. When you are receiving the first compensation, 10% is deducted. When you are probably receiving enhanced compensation 2 years later or 3 years later, at that time also there will be a deduction of 10%. And capital gain also splits the treatment. So capital gain also treats the first compensation in the relevant year, subsequent compensation in the year you are receiving. So TDS is also split. So it is for both. Whether this 5 lakh has to be considered for that payment or not, right? So the word used is or. So if one of them is crossing that, is what is there. They are not using the word aggregate. So they are not using the word aggregate. It's only or. So whether the compensation or the enhanced compensation or consideration or enhanced consideration. So it's only an independent thing. So standalone, if you are receiving more than 5 lakhs, they must deduct. Ideally, when they are settling for the first time, they do not know that there is going to be another compensation. So for the first time there is no confusion, but for the second time, if that is less than that limit, TDS need not be deducted, because the word aggregate is not used in the 194 LA terms. I. Hmm. No, the provision says 50,000 a month or a part of a month. So if that month it does not cross 50,000, it is not applicable. So in that month your rental is only 40,000, not 50,000. For that 40,000, not applicable, because for that month it is 40,000. You are talking about a fixed place or something else? Hall rental is different. See, hall rental as a different concept. When you're taking a fixed place for rental, this concept is straightforward. 50,000 in a month. If it exceeds, you have to deduct. Otherwise, not required. But if it is not a fixed place, it's a hall rental which you're taking. There is a clarification provided by the department which says that if you have an agreed terms with that hotel industry or with that particular person who is providing you that hall, if you have agreed terms, what are they calling as an agreed terms? Either you have fixed a fixed rate forever, or you have a fixed dates. Whenever I ask, it must be available for you. So there is an agreement between you and that concerned hotel or space provider, whoever it is. If there is an arrangement between a fixed arrangement, then it comes under 194C, not 194I. If there is no fixed arrangement, it's a one-off case, I am renting it for one single time, then of course it's not 194C. We need to check whether it is 194I. Correct. Right, 1 lakh.
So, in the first month it is more than 30,000. In the second month, if it is less than 30,000, whether I need to deduct TDS till the aggregate?
It is or condition. So, moment one bill crosses 30,000, it is applicable for all the transactions. Then you need not check 1 lakh. See, 1 lakh comes into picture. Let's say I am getting 20,000 bill, sixth time when I am getting, then it crosses 1 lakh. Of course, I have to start deducting it. So, moment it touches 1 lakh, I have to start deducting it. But 30,000 is an independent limit. Moment it crosses, one single bill crosses 30,000, it is applicable for all the transactions for throughout the year. Let's say I was only getting 10,000, 15,000. No, it's not applicable. So 194I, it doesn't have an aggregate limit. Earlier it was an aggregate limit. It was 2.4 lakhs. It's not bothered about whether monthly what was the rental. But now it has been introduced as the monthly rental. So now there is no aggregate. There is only monthly. 194C alone has that concept of independent bill, aggregate bill. That is continuing in the bill also. So this is there, but there is a small change in 194J what we discussed, that we will discuss. Rest of the thing, the limit is same. Yes, sir. Yes, sir. Ideally, what happens is, moment I am renting out a space for a day or something, it comes under 194I. But as I told you, there is a term which says that you can enter into an agreement or an arrangement with that person, calling it to be a contract. So in that case, 194I will not be applicable, 194C would be applicable. But in the Mari Kalyana Mandabam, in the Mari Randa, it will definitely be one time I will not have a regular agreement with them. So automatically it is covered under 194I only. So if a person who's supposed to deduct TDS, that is leave out the regular individual's HUF, if someone is letting it out, then it is applicable. And moreover, there is a common thing, if it is for 194C and 194J or H, as a point which says, if identified for a personal reasons, if the contract is for personal reason, if the professional services is for personal reason, if the commission is for personal reason, TDS is not applicable for C, H, J. There is no such clause in I. There is no such clause in I saying that if it is for personal reasons, you need not deduct. There is no such clause. So which means in 194I, it could be personal, official. Moment I am a person who needs to deduct TDS, I am supposed to deduct TDS. I need a individual has to deduct if that individual is an eligible individual, even if it is for a personal reason. Because this clause is not there in, this exception is not there in 194I, which as there in C and H, there is there. And 194IB also says, it is only for the persons who are not covered in I. It is, when it comes to M, it talks about also transactions not covered. That it covers personal transactions under M, not C, H, J. But I doesn't have such provisions, IB doesn't have. So it is applicable for personal also. So if it is a mandabam for personal reason, it is 194I only, it is applicable. See, basically TDS does not necessarily categorize what is the nature of expenditure. For example, that you have for capital expenditure, personal expenditure like 194 IB, 194 M is for personal expenditure only. So it doesn't categorize about personal or business. Wherever it is not allowed for personal, not there for personal, it is specifically stated. There is no such provision in interest, there is no such provision in rental. Rest of all the clauses were only for business purposes like C, H, J. You have a separate clause where it says it is not for personal expenses. You don't find that in 194I. So in that case, the intention is to leave it open, because why probably they would have left out is 194I, like CHJ, is not for all individuals. It is only for specified individuals. So for other individuals, you have IB. So that is like personal. This is like non-personal. It looks like that. But the word clause which is there in CHJ is not there in I. So that's what I'm trying to stress. So since that clause is not there, probably we have to include personal expense also. So I'm talking about that. Correct, sir. No, sir. 194I is applicable for rental, for any rental that is. It's not residential, it is not commercial, any one. For hotel it is rental income, it is a business income, but we are talking about, when you are talking about the TDS deduction, it is, you have to look at from your perspective what is it for you. You need not worry about what is it categorized on the recipient end. To me it is a rental, I will book it as rental. When I am going to book it as a rental, 194I comes into picture, irrespective of whether it is a business income them or not. The only clarification provided by department is to decide whether it should be C or I. In case of hotel rentals and other thing, there is a clarification to give whether it is C or I. So that is based on whether there is a fixed rate card, fixed arrangement between you and that hotel. Then it comes under C. If there is no fixed arrangement, it is categorized as I. So this is the clarification provided by the department. Yeah. Ideally, there also it talks about land building. It doesn't talk about what type of building or something. It even says it includes, in the recent bill, it says that it includes factory building also. So they are not categorizing what type of rental you are paying. Moment you are paying rental for the land or building, it is automatically categorized under I or IB. So it doesn't matter what purpose or what you are transacting. But when you are talking about this rental to that particular place, the land or building, another thing, the only differentiation with about for who are you, that is, are you a specific individual or not a specific individual. So moment that is decided, you either choose I or IB. You don't need to discuss about the purpose of the usage. There is one exception to this. It's called as cold storage. So where there is a warehouse, you rent out a building only. You will take a building on rent, but you need not pay on 194I. You have to pay under 194C. The purpose is the warehouse gives you something called cold storage. So the purpose of that cold storage is not only giving you that space, but giving you the facilities to store at particular temperature, at a particular condition, particular situation. So all this is decided. So since there are other facilities apart from the space, they say that it is not 194I, it is 194C. So this is applicable only for cold storage owner. The rest of the thing comes under 194I. Yes, sir. Auction. Yeah, yeah. What is the arrangement, sir? Is it rented as storage arrangement or it's something else? Mm. Understood. auction is conducted by that warehouse depot or that them. So again here, like similar to like here, the ideal transaction, for example, the base transaction is not storage. The base transaction is selling that through them. So that is the base transaction. So 194I is not applicable. A similar case study is one of the tower mobile towers. They are called Indus towers. So their business is letting out of towers, letting out the towers to other mobile providers. So now the question came out: should we treat it as a equipment hire or a place hire? What should it be 10% or 2%? The court went on to say it should be 2% and not 10%, because the purpose of renting it out is not the place. The ideal reason why you are renting it out is for the tower, is for the equipment in the tower, is not for the place. Place is incidental. Place is incidental. So this is what the word used in the decision. So since place is incidental, you can't question the question of 194I for building doesn't arise. But is it clear in the agreement, sir? The purpose is not to store. The ideal purpose is not to store. Okay. Okay, understood, sir. So maybe try referring to this type of situations where I referred to Indus towers, where it is very clearly says if the place is incidental. If the place is incidental, you cannot question it as an rental income as a business for the place. Correct. Correct. That's not the base objective. Correct. Correct.
It should be treated as a rental income. And it should be allowed as a business expenses.
Correct. It must be allowed. So this probably try putting it in this manner, that the place is incidental and not related to this, referring to this case. It's Indus towers where it was held on this case. Maybe you can try referring that and similar cases and try it out.
Where my income is fully exempted. Agriculture income is the main income. Whether TDS applicability is mandatory for the farm labor, or if I hire any tractor or harvesting equipments?
The TDS provision is not based on whether I have taxable income or not.
Okay.
It is based on whether I am an eligible person, whether I am an eligible deductor or not. Okay. So moment I am an eligible deductor, irrespective of what income, irrespective of whether I am making loss, profit, whatever, I must deduct TDS.
So the second question is, what is the TDS applicability for an tax exempted entity? Say I am a ITG or a 12A entity. Whether your previous answer applies to a tax exempted entity as well?
The relevant provisions, for example, 194C specifically includes the person who needs to pay. They are also including trust and NGOs there. So they are including them also. So they are never exempted from not deducting. So whoever is claiming exempt income or not. So whichever relevant provision is applicable, we have to only check whether they are an eligible deductor or not.
Okay.
So otherwise it's applicable. The same provision which is generally applicable will be applicable for them also.
Thanks.
Yeah.
Storage is the real substance, right? Because ultimately the auction is going to happen. In case there is some natural heavy rainfall, something like that, the storage has to continue for another 3 months or something. So here the underlying thing is storage rather than the final action of auction, which happens in one day, maximum one day. So how do you interpret that?
See, that's what we have to go into that agreement. We have to look at the agreement conditions and other responsibilities, what is there. If the responsibility is actually selling and I will take your goods and sell it, in that case whatever I am doing in between is incidental to that final activity. It could be a 1 day or 10 days, because my agreement is to sell, is to sell it to someone. So storage is an incidental activity. So we need to see how strong the agreement is about that storage relevance. If, as you said, it talks about the storage predominantly and not about the sale, then of course we need to consider it as a storage premises, rental will come into picture, all that. But moment the transaction, the agreement is on the sale, my purpose is to store. For example, I am a trader, I will collect the goods, I will keep it in my place, I will sell it across. He will pay me money I will purchase from him, I will sell it to him, right? So this is like a trading activity. So this arrangement, we need to see how it is structured there. Is it just a routing through mechanism as a place, or that is the base place?
The ultimate responsibility.
So we have to look into that,
Thank you, sir.
So anything else?
The manpower supply, including the inwarding of goods, storage, and then packing and repacking and outward. All these are being taken care by the warehouse personnel. So in this case, will this be still considered as renting of premises, because that is also being carried on, and sometimes there will be transport arrangements. So it is basically 3PL services. So here, will this still be considered under 194I, or it will be considered as a contract?
So you mean to say that I will hire someone, not just the whole business activity?
Yeah.
So I will hire the place.
Mainly looking into the inwarding, storing, all the outwarding activities also. But that will be all their place, or they would have even rented it out, and then it will be their labor.
Okay. So when I receive an invoice from them, what will be quoted as a service?
It will be all, it will not be their goods. Say I am that person whom I am letting out. It will be your goods. You will be the seller, and then your customer will be the person I will be transporting.
Right.
I am
but
just a person.
You will be raising an invoice for me to charge.
I will be raising it for you in the name of rent.
In the name of rent. Okay. So probably, as we were discussing, we need to look into the agreement. This doesn't look like a straightforward rental arrangement.
There are multiple cases. Like one, there will be fixed rents also. Some it will be in the case of based on the handling. If the number of goods, volume based handling, the rates will be different. So there are multiple. There are cases where fixed rents are there, and based on the units. So that is also there. So in that case, if it's based on units, will that still be considered under that?
As we were discussing, like as we said, for example, I'm sending a courier direct. Every time I'm sending a courier, I send it to, let's say, professional courier. They store it for a week and then they send it. Here the transaction is not that storage, is the courier service, right? So if I'm paying for that service other than the storage, if that is the objective of the entire transaction, then we need to see how the agreement is structured and how it is built. Moment an invoice states rent, we go on the weaker side. So but when you say it looks like it is a very mix of activity, it is rental is submerged into that activity. So it's a very whole lot of activity. So we can very well classify outside I in this case. But agreement has to be strong. Invoice has to be very clear that it is not rental. It is basically a freight forwarding service, or it could be a transportation service, a logistic support. You could refer anything under the invoice, but it can't be rental. It must derive from the agreement.
But if the other person treats this as rental expenses,
that is not relevant.
That will still not
that is not relevant. How is it treated in the recipient hand is irrelevant for the TDS purposes. In fact, 194R very clearly specifies that. You need not check whether it is an income for the other person or not. You need not check that. TDS matters as long as it is a deductible section, deductible provision, and it is applicable. You need to deduct. You need not check whether it is exempt or not.
And just one another thing, on a practical note, this Kalyana Mandapam thing, what we were discussing, I don't think any individuals would detect it because they would not even be practically aware of such thing. And then is it still that everyone is violating or doing this? Because practically that is not possible and they are not aware of such things. Right?
See, as we said, this 194I comes into individuals who are covered under that specified individual category. They renting out a premises for a personal thing is automatically is what we are talking about. Of course, there will be n number of people there not following this or something. As I told you, I am only talking about based on how the section is structured. This is not specified clearly in the 194I, whereas it is specified in CSJ. So I am saying it is applicable. So personal reasons it is applicable because of this clause differences. Yes, of course, there is a deviation only. But again, always it goes on the materiality level. Whether it matters to the department or not depends on the revenue loss and the number of transactions and other thing. Maybe such things are not quite a number, so they are not bothered about. Otherwise, they'll step in and bring something into that. For example, that is also for GST purposes. Moment you go to any mandapam, they ask you with GST or without GST. That's probably the first question they ask you. So accordingly you answer, accordingly the arrangement matters. So that definitely is there. Yeah. So that definitely is there. So but this, I think, for instance, take HRA. Earlier there was no check on HRAs. You can say how much ever rental you want, whichever PAN you want to give, you can give. 8 years back or 9 years back, they brought in this concept of 1 lakh rental or above, you have to declare. You have to start declaring the PAN. Then what happened? They were declaring the PAN of their choice. Known persons, old landlord, etc., etc. Last 1 year, what is happening from the department? They are sending notices. They are sending notices for what? They are sending notices to the company, not to the employee. They are sending notice to the company because to this AAS reporting portal, you get an information. Who gets the information? The so-called landlord. So-called landlord gets the information. He has to confirm whether it is his rental or not. Moment that person says it is not rental, notice is sent to the company saying, did you verify? So now company is put at risk of non-deduction, non-compliance on TDS provision. So now automatically what happens? They have brought in a check mechanism of rentals because they have started realizing it is important. Same way with to claim the whole HRA as exemption, you are declaring rental of 70,000, 80,000, etc. Then now they have brought in that limit of 50,000 because after 50,000 you have to deduct TDS. As I told you, TDS is a mechanism to cut down. Of course, if such things are very material or something, I think they will step in and bring something. Yeah. They've ready. There's what time is break? 3:15, Nana. Okay. Okay. Fine. So we'll 15 minutes break, is it? So we'll meet at 3:30. Yeah. So last few amendments we'll rush through in this. First one related to non-filing return. There are a couple of provisions. TDS 206AB, TCS 206CCA was there, where they said non-filing return TDS is applicable. This was introduced in Finance Act 2021. Introduced பண்ணும்போது they said 2 years return பண்ணிருக்கணும். TDS 25,000 for normal, senior citizen 50,000 இருக்கும்லாம், they were resident இருக்கணும். So these were the conditions which are listed. Only if you have filed return, only if you have filed your return on time, you are eligible for regular deduction. Otherwise, higher deduction like your 206AB Mari, 206AA, similar to 206AA, it is also applicable for 206AB. So this was the case for what was there. Same provision was there in TCS also. Then in 2023, Finance Act 2023, they removed 2 years, instead of 2 years, they made it 1 year. So which means I should have filed my return for one last year, it is applicable. So now automatically what happened was the process was reduced, but still this was always very complex because I have to tell whether I have filed my return, how will I prove through my acknowledgement or ITR or something, but it's a very personal information. There was a confusion on this on Finance Act once it was introduced, but then very lately government introduced to a process in reporting portal where you can go and check on your own. Put that PAN, check whether they have filed the return, whether they are compliant to 206 AB or not, and then accordingly you can decide. So you need not get it from the vendor. But even otherwise, what was happening was everyone was sending you a mail. Send me the IT acknowledgement number, send me the details, relevant details, all that was there. So there was always this confusion on why is this actually required. Finally, in Finance Act 2025, they scrapped this. So no more 206 AB. So hereafter, a higher deduction is only on 206 AA and not on AB. TCS, we leave it. We will discuss about this foreign remittance a little later. The last point was relating to offense and prosecution. This also probably some of you would have faced with some of your clients. So typically what happens is there is a provision under 276B and 276BB which says both TDS and TCS should be paid on time within the due date of payment. If it is not paid, they are liable for prosecution. What is a prosecution? 3 months to 7 years of imprisonment along with fine. So this was a prosecution that was in place for with respect to your 276B and BB. This was very cruel at times because even for 2-3 days delay, recently last year what department was doing is whenever the payment was more than 10 lakhs where there was a delay, they kept sending notices saying that there was a delay. So they summoned the directors, they wanted to prosecute and all that process was happening. So this is unnecessary headache for the assessee or the consultants, all of them. So what department decided in Finance Act 2024 is government removed this prosecution for late payment for TDS alone. But they did not say late payment generally. They said payment can be late, but it has to be paid before the due date of filing your TDS. So you can pay it late, but not later than the TDS due date. So that is what they said, filing due date. So for instance, if you are talking about Q4, the due date of return filing is 31st May. Payment date is 30th April. So they are saying that you can pay late, but pay it before 31st May. Don't delay beyond 31st May. So this was what was given in TDS. Same for TCS, 15th you have to follow. But now this prosecution is removed based on this condition. What condition? Still you have to pay, but you have to pay before the due date of filing return instead of due date of payment. So this is the difference that is highlighted. So now this has been followed for TCS also in Finance Act 2025. So now it is common for both the provisions. So both for TDS and TCS, late payment does not result in criminal prosecution. So that is a relief. So these are the recent updates. Of course, how has this transformed into the bill? We have been seeing, we saw the structure, we saw the sections which are flowing in from Act to bill, all that we saw. We'll now specifically understand how they have modified the bill. We'll take up some example of some selected sections and see the flow. What was that? We are similar to what we saw for section 190. We'll see for some 4 or 5 sections. So we will first understand how this TDS is structured. I said everything comes under section 393. You need not remember multiple sections. Everything comes under 393. Now within 393, there are 11 subsections. Now number one, every section or most of the sections other than close to 6 sections are classified via table, not based on theory, not based on legal references. So how is it structured? First clause, first subsection refers to payments to resident. They are classifying payments to resident as 8 different categories. So that is subsection 1. Subsection 2 is exclusively for non-residents. any payment made to non-resident. So moment you know the payment is for non-resident, go to subsection 2. Moment you know the payment is for resident, go to subsection 1. If it is for any person, for common section, it falls under 3. So 3 talks about any person which is categorized under 7 categories. So that is 3. 4 talks about, now if you actually look at it, every section will have exceptions for which TDS is not applicable. There will be relaxation. For instance, we said 194O, where up to 5 lakhs, where PAN is given, declared, TDS is not applicable. 194C, logistics business, 44AE, presumptive taxation for logistics business. What is that business all about? How many vehicles you can have? Up to 10 vehicles. So up to 10 vehicles at any time during the year, if you have, you can choose 44AE. Now, if you are covered under 44AE, 194C is not applicable. You need not deduct TDS under section 194C. Such exceptions are covered in no deduction at source, number 4. So that is what is covered in 4. Then 5 is specifically for not deductible for persons. That is, for these persons you should not deduct TDS. This is similar to section 196. 196 says if you are paying any payments to bank, government and so on, you need not deduct TDS irrespective of the nature of payment. So such transactions are discussed in subsection 4. Subsection 6, wherever you must obtain a declaration from the respective person, it is discussed in section 6. Wherever some declaration is required is discussed in subsection 6. Then subsection 7 is a support thing, that is a support for subsection 6, which talks about a statement has to be furnished separately to the government for details relating to subsection 6. That is, this declaration needs to be filed with the government wherever they are covered under subsection 6. What is that all about? That statement is nothing but, we would be very familiar with that statement, Form 15G, Form 15H, which is discussed in 197A, where it says whenever you are TDS need not be deducted. It could be salary, it could be interest, it could be rental. There are some 6-7 sections which are allowed. For that sections, if you need to submit a declaration saying my income is less than the basic exemption limit, so TDS is not applicable for me at all. I have to file what? Form 15CG is for regular persons. For senior citizens, I have to file Form 15H. So that is discussed in subsection 7. 8 and 9 is specifically an exclusion saying that you need not give any declaration. If you are covered under these two categories, automatically there is no TDS requirement. They are called as offshore banking unit and national pension scheme. So if any interest is paid by them, they need not deduct any TDS at all. So automatically when they are paying TDS, no requirement of giving any declaration. So that's subsection 6 to 9 is discussed in 197A in the current act. So it is now covered under bill in this section. 10 discusses about TDS should always be whatever amount as TDS has been deducted is net amount is what you will receive. Sometimes what happens, the concerned person will not agree for the TDS. So which means you will have to gross up. So tax payment TDS is always net of tax. If it is 100 rupees is the invoice amount, I will pay 10 to the government, 90 to the concerned customer. So this is what I will generally do. 100 split into 90 and 10, 10 being TDS, 90 is net of tax. What I will receive is 90. But if I do not want TDS to hit me, I can ask them to gross up. What will I do? I will gross up 100, which means it will become 111. Because 10% on 111 is 11, 111 minus 11 will give you 100. So when I gross up, I will receive 100, 11 is TDS. So generally TDS is always net of taxes. If wanted, if required, the concerned person can gross up, saying I will not take up the TDS, so you gross up and give me. So automatically that system is discussed in 195A in the current act. It is discussed in 393 itself. They are not wasting another section in the bill. And last one is, in most of the section, what do you mean by most of the section? Wherever TDS is required to be deducted at the time of credit or at the time of payment. Lot of TDS provisions, take 194C, H, J. For every sections, TDS is deductible at the time of credit or at the time of payment, whichever is earlier. So this concept is there. Now, what do you mean by credit? Which account should be credited? There is another clause in most of the section which says, even if you are crediting suspense account, if you know the vendor, if you know the amount, TDS must be deducted. So that is described in most of the sections where it says the hit need not be to the vendor, it could be to any account including a suspense account. Moment it is credited as a transaction, TDS is applicable. So this is covered as a clause in most of the sections. We'll discuss that. Now this is also covered in 393. 393.11 says this is also covered under 393 itself. Instead of independent sections, instead of repeating the same clause 47 times, they are repeating only once. So which means it's common for all the TDS provisions, be it payment to resident, be it payment to non-resident, be it payment to any person, whichever section TDS is applicable, this is a common clause wherever TDS is deductible on credit or payment basis, whichever is earlier. So this clause is discussed in suspense. We'll see the clause comparison for this also. So this is what we are going to do. So we are going to understand how is this structure happening. When I say suspense is from this clause, this represents 197A. We are going to literally put the law act and then see how it flows. We'll take 194C and we'll compare how it is structured in your bill and how it is structured in the currently in the act. We'll start from clause 1. I'll not read in detail. Of course, clause 194C subsection 1 says, for what transaction TDS is applicable? For what transaction TDS is applicable? TDS is applicable only for transactions where the contract is entered with a specified person. Contract is entered with a specified person, and it is 1% in case of individual, 2% in case of non-individual. So this is the base system that has been implemented. So what are they saying? They are saying it could be paid to any resident. So it is specifically for resident, it is not for non-resident, and the timing of deduction at the time of credit or at the time of payment. So it is applicable at the time of credit or at the time of payment, and it is 1% in case of individual or HUF, it is 2% in case of anyone else, and income tax should be calculated on that amount. Now how is 393 linking to 194C? First part, we are going to take a common clause. What is common clause? This clause is going to be common for all the payments made to resident. All the payments, any payments made to resident, this clause is common. How is it common? Now compare this. This also talks about 393.1 says it is applicable when the payment is made to a resident. Now they are calling some column B, C, something. So we are going to link it to the table and understand this. So that is what this bill is trying to do. And they are saying TDS must be deducted on the entire amount if it exceeds the threshold of column D. Entire amount. So moment it exceeds the threshold limit, it is applicable on the entire amount at the rate specified in column D. So what are we understanding? Column D tells you what is the rate, what is the threshold limit. Where here in the act it is theory. Here you are going to have a column which is going to talk about what is the rate, what is the threshold limit. And what does C says? For all these transactions covered under 393.1, tax must be deducted at the time of credit or the time of payment. Same thing. So whatever you are seeing here is also there. Payment to resident is there. Time of credit or time of payment is there. Subject to provisions of subsection 4, 5, 6, 8, 9. We'll talk about that. Now this is the base section. What are you calling it as a base section? This is common for all the payments made to a resident. Okay. Now we'll move into the table. Now 194C, I am repeating the same thing, but I am highlighting different things for better understanding. Now I am highlighting any work including supply of labor. That is, the TDS must be deducted for any work which is including supply of labor for carrying out any work in contract between a contractor and a specified person. So this is what has been called as thing. Now how is it linked in the table? C61. What does 61 says? 61 says any sum for carrying out any work including supply or labor carrying out, no change in the words, but for one word. What is that word? There you see the word specified person, here you see the word designated person. So, but the explanation to the specified person and designated person is same, that has not changed, but they are using the word designated person. Why? Because wherever we are referring to sections like 194CH, we are going to call TDS is deductible only by specified person. The term specified person is going to be used in CHJ related provisions, because there it is automatically applicable. So here C alone, what are you calling? There you are calling it a designated person. In H and J you will call it as specified person. Why? Because C gives you a very detailed list of persons who are covered, whereas H and J simply says it is applicable to persons other than individuals and HUF, but it is also applicable for individual HUFs if their business turnover in the immediately preceding year exceeds 1 crore or professional receipts exceeds 50 lakhs. So this is what has been highlighted in the relevant provisions. Now here you are calling them designated person, everything else remains same. 1%, 2%, threshold 30,000, 1 lakh is also discussed, but that comes into the act at a later part. This 30,000 and 1 lakh is discussed in subsection 5 of 194C. So now the 30,000 and 1 lakh is linked to subsection 5. What does subsection 5 says? No deduction when the sum does not exceed, 30,000 rupees or the aggregate sum during the financial year exceeds 1 lakh rupees. So it is either 30,000 per bill or 1 lakh in a financial year, only then it is applicable. How does it draw into the bill? It comes as one simple line on the column D. Column D, what is the threshold limit? It says 30,000 or aggregate amount, 1 lakh in case of aggregate of amounts. That's the difference. They have just added the S. They are not explaining aggregate of all the invoices, nothing. They are just saying it is aggregate of amount. It's not plural, which means it is one invoice. Aggregate of amounts, which means it's multiple invoices. So one invoice is 30,000, multiple invoice remains 1 lakh. So that is same. So nothing has changed, just that it has been brought into table where column A represents a serial number. This serial number is what is very critical when it comes to hereafter when we refer before assessing officer or any of the representation. Serial number is what we must know. We are not going to say 194C, we are going to say 393.1 table serial number 1. So we are not going to call 194C, we are going to call it as 393 subsection 1 table serial number 1. This is the reference that you have to do for 194C. So this is how they are linking. You need not refer the section numbers, just refer the serial number. So the column A is very, very important. Column A. Correct, yeah. I said 7 categories, so that is what 6. So there are totally 7. In fact, this payment to resident has 8 categories. So this will have 8 categories. So each category will be divided. If you see category 6, it is not only contractor. It also has what? Professional and technical services. So which means C and J are combined. C and J are combined. And you see the word etc. Correct? Commission is also given in one of the clauses under 6 itself, which is commission covered under 194M. 194M commission alone is covered here under this particular serial number 6. So what is important? Serial number 6. After that, what is important? The numerals of italic numerals, which is 1 in column B. So equivalent of 194C is serial number 61. Serial number 61. 61 is the equivalent of 194. So you get my point here. So this is how they are linking between the act and the bill. So that is 61 where they are. We'll move on. We have only seen 194C. We saw the first subsection. Now we are seeing 5. There are several subsections within 194C. Where is that going? Section 194C2 says suspense account. suspense account. We spoke about the term, right? Where is it in 393? It is there in subsection 11. Subsection 11 talks the same term. Now compare and see. What does 194C2 says? Where any sum referred to in subsection 1 is credited to any account, whether called suspend account or any other by name, so on and forth. Come below the same thing. Credit of any income or sum to suspense account or by any other name verbatim shall be deemed to be credit. So such crediting shall be deemed, here you say, shall be deemed to be the credit. So some simple shifting of words where you feel it is straightforward rather than complicated understanding. So that's what they have made here. So this is with respect to suspense accounts, which is 194C2 compared with 393.11. So section 194C subsection 2 has come into 393 subsection 11. Now what about subsection 3? 3 says whenever an invoice under section 194C with material, without material. So generally 194C is applicable only on the service element, not on the material element. Now how do I differentiate whether how much is service, how much is material? I cannot differentiate. It must be there in the invoice. Invoice must tell how much is service, how much is material. If the difference is there, if that segment is there, if that breakup is there, you can deduct only for the service element, not for the material element. Otherwise, TDS is supposed to be deducted on the whole material, whole bill including material. So that is what. Now that is given in 3. What does it says? Deduct TDS on the invoice value excluding the value of material. You exclude the value of material if such value is mentioned separately in the invoice. That's what is given in 3. Now 3 clause 2 says on the whole of invoice, if the value of material is not available. Value of material is not available. Now what have they done in the bill? I told you, right, they have brought in notes. We don't have 1200 odd provisos, we don't have 900 odd explanations, but we are going to have notes. And we know how many notes will come up over a period in time. So currently there are very few notes, but of course that's what is going to increase. So for the next 50 years, of course, we need not worry. So basically in serial number 6.1, they have referred, see how have they referred? In serial number 6.1, if any sum is paid or creditor for any work specified in 402.47E. 402.47E. What is 402? The definition section. What is 47? Definition for work. What is E? Which says that I am doing a job work. Someone is giving me a job work where material is also involved. So for this reference, you have to do excluding value of material and then excluding the value of material or thing. There they have said subclause E of clause 6 of the explanation, clause 4 of the explanation. That is nothing but same. The 4E reference has gone to 402.47E. That's all. E remains same because the definition has not changed. What is A here also. What is B here also. What is E here also. But what has changed? Explanation clause 4 has changed to note under 402.47. So this is the cross reference that has been brought. Yeah. This end of the 6, there will be a note for 6 immediately. So you need not go and search somewhere. It will not be combined into one area. Note for 6 will be under note 6. Note for 8 will be under 8. So you need not search around. It's very straightforward. Now the 6, 2, 3 and all as about other areas, technical series, other thing. Immediately after that you will have this note. So this is also a screenshot here. So this is immediately after note 6. Immediately after the 6, serial number 6, you will have the note. So you need not search around. It's that is very simple. Of course, these references will take time because everything is defined in 402, not within the section. So it will take some time. That is about the section 3. So we have covered 194C, we saw subsection 1, 2, 5. Now we will see next other part. 4, 6 and 7. What does 4, 6, 7 says? 4 says if it is paid for personal purposes, it is not applicable. 194C is not applicable. We are discussing, right, about personal purposes. This clause is there in CHJ. So that there is an intention behind this clause. So if something has to be excluded, government will be giving that as an explanation. Now this clause is absent in some of the sections. It is not there in 194I. It is not there in 194A. It is not there. So wherever it is not there, ideally you have to consider that it doesn't matter what purpose it is. So now personal purpose. Second exception is leasing goods or carriages. Under whichever is covered, plying, hiring, leasing goods or carriages, and then they should furnish a prescribed authority. So basically the leasing goods or carriages should give you a declaration saying that I have less than 10 goods vehicle with me and this is my PAN. So that declaration should be submitted. Then there is no requirement of TDS deduction. Now how is this flowing? 393(4). 393(4). So far we were discussing what? 393(1). 393 subsection 1. Wherever we are talking about serial number 6. Serial number 6 was where? Was there in section 393 subsection 1. Now this is covered in 393 subsection 4. What is subsection 4? Subsection 4 talks about situations where TDS is not applicable on such some transactions. It's an exception. Contract only, it is a contract, but you need not deduct TDS. So that exception is given in 393(4). 393(4). This is the flow that we are talking about. So what does it say in 393(4)? Serial number 8. Serial number 8. Here you have only 3 columns, A, B, C. A is serial number, B talks about the nature of transaction, C talks about the exception. When is it not deductible? C, A, B, C, only 3 columns. In sometimes you will have 5 columns, A, B, C, D, E. So we need to understand how it is structured. How does it say? A, B, C. A says 8, B says 393(1), table serial number 6(1). For contracts referred to 6(1). What does it say? 6(1). 6 payment to contractor, 1 any sum. So 6(1). So 393(4). 393(4) is referring to 6(1). So for that, what are the exception? Any sum, then you need not get confused. Same reading. Any sum likely to be credited during the tax year, during the course of business, plying, hiring, leasing or goods or carriage. Same words. That contractor owns 10 or less goods anytime during the year, furnishes a declaration, person responsible for paying, furnished to the income tax authority. So that is A, which is about 6 and 7. 6 and 7 is discussed in A. Now come to B. What does B says? For personal purpose of such individual or HUF. Personal purposes. Where is it discussed? 393, 194C(4). So all this comes under now where? 194C(4), 6 and 7 gets flown to where? To 393(4). Why 4 and not 1? Because it talks about exceptions. Exceptions are covered in 4. Taxability is covered in 1, 2, 3. Please remember that. 1 is for residents, 2 is for non-resident, 3 is for any person. 3 is for any person. Wherever TDS says payment to any person is subject to TDS, you have to see table 3. Only to resident, table 1. Payment to non-resident, discuss in 2. So this is what is there. So 393(4). So now we have discussed all the 7 subsections of 194C. But there is also explanation to 194C. What is that explanation? Definition for the terms. Now where is that belong to? Section 402. Now we'll see how that flows. 194C explanation 1 explains you who is a specified person. Who is a specified person. 402(37) describes the same person. There is no difference between specified person, but what is the term used? Designated person. Designated person. So same thing. So in act they are called specified person. In bill they are called designated person, because in the bill specified person is used for other sections where it is not applicable for that specified category and the business tax audit person solromla. So that category ki it is discussed separately as specified person. So bill is alternatively using the word designated person. So that is what. Next, what is goods carriage? 194C explanation 2, it is given here in 402.18. Contract, what is a contract? Explanation 3, clause 10. What is works contract? Explanation 4, here 47. Remember we saw 47E there. 402.47E, which is nothing but 47 defines what is a works contract. Earlier explanation clause 4 was defining work contract. So that comparison is what we are bringing here. So now I have been repeatedly talking about 402. So 402 I already told you that it's a definition section, interpretation section. So we'll slightly dive into that and understand. So it is definition section for chapter 19. 402 is the definition or explanation section for all the TDS, TCS related provisions. So not only for TDS, it's for the whole chapter 19, TCS, Advance Tax, for everything it will be there. So now Bill has introduced this thing for a single point reference. So whatever you need relating to that chapter, you need not search for definition, go into that one single section which is called interpretation and look for that. If it is not there, then maybe in section 2, if not in both, a general legal understanding could be taken away. So this is what 402 supports. But sometimes definitions are not straightforward, they don't directly define. You would have seen definitions should sometimes will link it to other act, external acts. It might link to SEBI, it might link to or your foreign exchange, FEMA related matters or any other act where they'll call for a definition. For example, here we'll take this goods carriage. Goods carriage is defined under 194C, where in that definition it says goods carriage refers to whatever has been defined under section 44 AE 7. What is 44 AE? Presumptive taxation. What is 44 AE subsection 7? Defines what is a goods carriage. But what does 44 AE 7? That also does not define. 44 AE also does not define goods carriage. What does 44 AE says? Both of the act refers to Motor Vehicles Act. They say whatever is goods carriage defined under Motor Vehicles Act, section 2 of Motor Vehicles Act, that only applies to 44 AE 7. So I will first refer 194C, it will link me to 44 AE, it will not give me an answer, it will again take me to some other act, right? Same thing Bill also does. Bill is not doing anything different. What is Bill doing? Bill is saying refer to, in 402.18 it says refer 5810D. What is 58? Section for presumptive taxation. One single section for all presumptive taxation. 44 AD, ADA, AE, for everything one single section. No multiple sections. So it is all covered under 58. 5810D discusses goods carriage. What does it say? Refer section 2 of Motor Vehicles Act 1988. So this is how they have not changed such things. Such things continues in the act and the bill. Then nothing has changed. So this is how it flows. So any doubt in this understanding? Table, serial number, notes. So these are the key things that I want you to understand. So be very clear that every section is flowing into a TDS section is flowing into section 393. Depending upon to whom you are paying. If you are paying to a resident, look for 1. Non-resident, look for 2. Generally, if it is applicable for any person, look for 3. Then for what exceptions are applicable, on which TDS is not applicable, 4. So these are the 4 things which are critical. These 4 tables is what makes it important. We'll see one more case. We'll see 194 IB. We have been talking about this section also. 194 IB has 1 and 2, where 1 says it is applicable for every individual HUF who are not referred under 194I, right? Because 194I says it is applicable for individuals HUFs whose business turnover is more than 1 crore, professional receipts is more than 50 lakhs. For others, 194 IB is applicable. So here what are they calling? Here they are calling refer 2.1. 2.1 says income by way of rent. So in section 393.1 table, serial number 2 represents rent. 6 was representing contract, professional, technical services. 2 represents rent. 2 represents rent. Now this is also categorized. For example, they are calling few transactions as capital markets, dividend, income distribution of mutual fund, all of that are called capital markets. Some clause, one clause is called immovable property. Anything relating to 194 LA, IA, all of that on sale of acquisition property, compulsory acquisition of property, all that is covered under one particular category. So this is also categorized. All immovable property related, all rental related, all commission related, all contractor, professional, technical service related. So there are 8 categories as I told you, right? So 8th category is others, whichever is not covered in the 7 comes under 8. So 2(1) income by way of rent. But who is paying? Column C says person other than specified person. Now who is a specified person? A person who is an individual or HUF whose business turnover in the immediately preceding year is more than 1 crore or professional receipt is more than 50 lakhs. So now here specified person comes into picture. Here it is not what word? Designated person. That is the reason 194C is using what word? Designated person. They have not just like that used that word, because there is another place where in multiple places you are already using the term specified person, which was not the case in the Act. Which was not the case in the Act. We did not call in 194I or something, we did not call a person called specified person. So the confusion was not there. Now in the bill, these persons are called specified person, those who are covered under 194I, H, J, etc. So person covered under C are now being called as designated person. So that's the shift there. Okay, person other than specified person. Rate 2%, threshold 50,000. Nothing has changed, right? Same. Come to 194 IB of the Act, subsection 2, income tax referred in subsection 1 shall be deducted on such income at the time of, please read this correctly, see whether it is clear or whether you are able to convey the exact meaning. At the time of credit of rent for the last month of the previous year or the last month of the tenancy, if the property is vacated during the year. Comma has so much of meaning, so you have to understand where comma comes so that you interpret accordingly. As the case may be, to the account of the payee or at the time of payment thereof in cash or by issue of check or draft or any other mode, whichever is earlier. So this is the clause used. So this has multiple avenues, which is explaining. So now probably if you have to understand, they have divided into 2 parts. First they are talking about credit of rent. Second they are talking about payment. Credit or payment, correct? Credit or payment. So that is what they are referring. But when they say credit, they are referring to another point saying that last month of the previous year or last month of the tenancy. So this is what they are referring. Now this clause has been redefined here. I feel it's much simpler and easier to understand. How does it say? Tax shall be deducted on such income at the time of A, credit of rent to the account of the payee, B, payment thereof in cash by way of check, whichever is earlier for the last month of the tax year or the last month of tenancy. Now they are very clearly saying you check credit or payment, check that whichever is earlier it is applicable, but when you need to pay, when should you pay? You should pay only in the last month of the year or the last month of the tenancy. So same meaning only, but this looks very straightforward, clear. A says credit, B says payment, whichever is earlier. Then they are adding the point saying last month of the tax year or the last month of tenancy. So if I am occupying a property from April to December, 194 IB arises in the month of December. If I am continuously occupying, it arises in the month of March. So that's what they are saying. So that is what we say. First check credit or payment. So that is a different concept. Credit or payment, whichever is earlier. Now when should I pay? When should I pay? I should pay it last month of the year or last month of the tenancy, whichever is earlier. So that is what we are taking. So now what else is there in 194 IB? 194 IB 3 says the provisions of section 203A shall not apply. What is 203? Yep. That is 194I. Yeah. No, this is IB. But this refers only serial number 21. 21 is only for IB. Same credit or month, because 393.1 when we discussed first, 393.1 very clearly says 393.1, that subsection 1 clause C says at the time of credit or time of payment, whichever is earlier. So this flows for all the sections. Wherever there is a change, you will have a note. So I told you, right, no proviso, no explanation, but you will have note. So this note is to change the general phenomenon of clause C of subsection 1. So that note represents only 2.1, only for 2.1, which is 194 IB, and not 2.2. 2.2 is what? 2.2 is for 194I. 2.2 is for 194I because it says 2% for machinery, plant or equipment, 10% for building, land and building. So 2.2 is for 194I, 2.1 is for 194IB. This note is only for 194IB. Clear? So that's that movement that they have brought. Of course, in the 2.2 kapron there will be threshold and all. Now I have just cut and put whatever is relevant. So we are discussing about 2.1 and this note. So I have cut other irrelevant items for the purpose of comparison. But 2.2 represents what section? 194I, because it talks about 2% for plant machinery, 10% for land building. So that represents 194I. 2.1 mattumna what it represents? 194 IB. Okay. Coming to 3, subsection 3 says 203A is not applicable. 203A is nothing but obtaining a TAN number. So you have for obtaining a tax deduction and collection account number. For that, 203A says is not applicable for 194 IB, which means you don't need a TAN to pay TDS under section 194 IB, because you pay it through 26 QC. So you automatically pay, it's not applicable. So where is it covered under bill? It is covered under section 397. Why 397? 397 talks about who should obtain TAN. Now the ideal place to tell that who need not obtain TAN is 397. Not that section. So now bill has pushed into where? Pushed into the relevant section. What is the relevant section? 397 talks about who should apply TAN. In that they are specifying every person deducting, collecting should apply, but it need not be applied. It need not be applied to a person required deduct tax under provisions of table serial number 21. Table serial number 21. What is 3.1? It is relevant to interest. 5.2 is relating to your, I think relating to your 194M. So for the specific clauses, they are saying that it is not applicable. That is, you need not apply. So 5 is about your 194IA, where TDS is not applicable, and 3 is related to another capital market. So for these sections, they are saying in one place, they are saying for all these sections, for all these clauses, you need not apply TAN. Otherwise, now I have to find out in that section. Now they have moved it to where? Moved it to one common section where they are saying where it is not applicable. Now we will move to 4. This is very interesting. 194 IB4 says wherever 206 AA is applicable. Generally, when 206 AA is applicable, that is when PAN is not given, what is the TDS rate? Highest rate, that is we will take 20%. So TDS is applicable at 20% rather than the regular rate. For example, in 194 IB the rate is 2%. Instead of 2%, you should deduct how much? 20%. Now subsection 4 says wherever 206A is applicable for 194 IB, it is restricted to 1 month rental. It is restricted to 1 month rental. Before getting into the bill, I will first try to explain why probably this provision is there. We will take a situation, I am paying 60,000 rental monthly, which is resulting in a year 7,20,000. According to IB, I should deduct only in the month of March. So across the year, I have paid 60,000, 60,000, 60,000. I have paid 7,20,000. In the month of March, when I am paying the last 60,000, I need to deduct TDS and deposit. Now, the owner has not given me the PAN. Now, how much is TDS rate? 20%. So 20% on 7,20,000. How much is it? 1,44,000. Now what should I do? Call the owner. Tell me, give me 84,000. Give me 84,000 because I have to deposit 1,44,000 to the government. We all know what will happen. He is not going to give that 84,000. So does that mean I have to put my own 84,000 on 1,44,000? It's unnecessary, right? So that is why government has introduced this provision of saying restricted to 1 month rental, which means my TDS is restricted to how much? 60,000 alone, not 1,44,000. So even though 206A is applicable, I restrict the TDS amount to 60,000, which is nothing but 1 month rental. So I call the owner, I will not give you this month rental because I have to put the entire money into TDS. That's all. Problem solved. So this is what is the intention behind 393, subsection 4 of 194 IB. Now where does it come in the bill? It comes in the place where 206A is explained. It is not defined under 194 IB. It is clarified wherever you are talking about 206AA. In left hand side we are talking about TAN, obtaining a TAN. It is discussed in the place where you are talking about obtaining a TAN. Right hand side you are talking about non-declaration of a PAN. You are discussing this in the place where PAN is not declared. So where is that discussed? It is discussed in 397(2). By mistake I put table here. 397 does not have a table. So it is 397(1), that is 397(2). So 397(2) says if the tax is required to be deducted as per class B1, that is 2(1), if it is required to be by serial 1, 393(1) serial 1, then such deduction shall not exceed the amount of rent payable for the last month. So now they are linking to what? Serial number 2(1). So different sections are linking to serial number 2(1). What is serial number 2(1)? 194 IB. So within 194 IB, I am just explaining. In serial number 2(1), I am just explaining the provisions of 194 IB. But other conditions and other thing in that place I am referring. So if I need to know whether I need to obtain a TAN, I will go to 397 and check whether I need to obtain. Similarly, if I need to obtain this, whether I need to deduct higher amount, I will see in 397(2) whether higher deduction is required. So I will have to look into one single place for all that similar plans. That's what has been the intention. So that is 194 IB. Last one is interesting. I think we were discussing about this. What is rent? There is a slight change in this definition if you actually look at it. 194 IB says very simple. Rent means any payment by whatever name call under any lease, sublease, tenancy or any other agreement or arrangement for any land or building or both. So land, building or both. So this is what is discussed as in explanation to 194 IB. Now we have to come to which section because it talks about the definition. So we have to jump to 402. So we come to 402. 29 explains what rent is. Now rent is also required for 194I, also for 194 IB, correct? So it's required for both. Now see what this definition does. Rent means any payment, same thing, lease, sublease, tenancy, everything is same, separately or together. So that is included, separately or together. Now come to the list. Land, building including factory building. C, land appurtenant to a building including factory building. Machinery, plant, equipment, furniture, fittings. Now they come to the last para where they are saying whether or not owned, any or all or above or owned by the payee. That is also given. And for the purpose of serial number 21, which is what? 194 IB. For the purpose of serial number 21, it refers only to ABC. So 194 IB relates only to land, building or both, correct? So now they are saying for 194 IB, that is serial number 21, consider ABC alone. What is A? Land. What is B? Building. What is C? Land appurtenant to building. Instead of using the word both, they are very specifically saying land appurtenant to building. And see the extra emphasis, factory building, That is not there earlier in 194 IB. So now 194 IB represents not only residential premises, even if it is for a factory premises, 194 IB is applicable if you are not covered under 194 I. So they are extending, very clearly saying 194 IB is not only for personal rental, it is for any rental paid, including factory building, provided you are not covered under 194I. If you are covered under 194I, deduct under that section. So this is the small change that they have brought under this particular clause. We will take one another section from the non-resident perspective to understand on the same perspective. Since it's non-residents, we have to go to 393.2. We have to go to 393.2 because 2 only is going to talk about payment to non-residents. Now 194E is a very specific provision which talks about three people, sports person, entertainer. They are not citizen of India. Sports person, entertainer, not a citizen of India. Third category is sports association who are a non-resident. So if they are being paid any money for anything relating to participation in India, for example IPL players or football players or anyone who is coming in India and playing, so for them if some payment is made, you need to check whether they are sports person or entertainer or sports association. They must not be a citizen of India or a non-resident. Now whenever that payment is made at the time of credit or time of payment, it is applicable. Now this entire transaction is described in 115 BBA. This entire transaction, taxability of this income is discussed in 115 BBA. The corresponding section here is 211. Here they are not explaining, they are just saying any income referred to in section 211. And this is payment to non-resident. It doesn't has 4 columns, it has 5 columns, A, B, C, D, E. In subsection 1, how many columns are there? A, B, C, D. A is serial number, B is the nature of transaction, C is the deductor, who is the deductor, D is the rate and the threshold. This is in subsection 1. Subsection 2, payment to non-resident, has 5. So A is serial number, B is the nature, C is payee, D is payer. So both are covered because payee cannot be any person. Payee should be whom? Only sports person or your entertainer or thing. But payer can be any person, a resident, non-resident, anyone. Moment they are played in India, it is applicable. What is the rate? 20%. It draws from 115 BBA. Relevant section is 211. Now 393.2 very specifically says it is only for payment to non-resident at the rate specified in column E, time of credit or time of payment. So there are 5 columns, A, B, C, D, E. So for non-resident there is a slight change. Not only deductor is described, both deductor and deductee, payer and payee are described in the table itself. So A, B, C, D, E is the column. We will see other some interesting changes. Yeah, please. They rent the stalls to the residents. When the residents are paying them the charges, okay, and that's the services happening. So in that case, since now you're mentioning only 3 people, correct. Yeah. In that case, 195 will come into picture. We need to see whether that will be considered as a permanent establishment or not. Moment there is an exhibition set up here, if that exhibition is of a foreign person who is setting up, we need to see whether that stall which is being set up should be considered as a permanent establishment, which is like a branch office of that foreign company. So the courts have established, for example, once a similar situation happened in a Formula 1 happened once in India, which happened only for a week. Generally, PE is considered to be a place of business only when it is there for 90 days or 180 days or something. But then the PE definition does not quote any number of days. It only says fixed place of business where a business operation is happening. So this is what has been described in 92F as a permanent establishment. We have an equivalent term called business connection, which also does not talk about number of days in 911. So courts have repeatedly held, moment there is a strong business happening at one particular place and you are generating a business income from that location, it doesn't matter whether it is 1 week, 10 days, 90 days. Moment it is a business income that you are generating from this location, you are supposed to pay tax on that money here. So it becomes a business income for the foreign company. I am telling you on a straightforward case. So once it is a business income, I have to deduct at the foreign company tax rate, 35% plus applicable surcharge and cess for that income. For this, I need to obtain tax residency certificate in case if they are able to give me no permanent establishment declaration. If they give me, then TDS is not applicable under 195, it will not be taxable. Not applicable. 194I is applicable only when I am paying to a resident. When I am paying to a non-resident, 194I will not come, 195 will come. When 195 comes, we need to check whether it is a specific transaction covered as interest, royalty, technical service or general business. If it is general business, it is taxable at foreign company tax rate of 35% plus applicable surcharge and cess. So for that, I need to get a no PE declaration, tax residency certificate and Form 10F. So some interesting things basically in this lower deduction collection. In the current act, there are some specific sections established. For what section you can obtain 197 lower deduction. So from salary, interest on securities, dividend, so on and on. There are several sections for which you can apply lower deduction. Now, but if you actually look at the reading in the new bill, they have removed that completely. So currently 395 talks about, section 395 talks about lower deduction for TDS, lower collection for TCS. Both of them is discussed in 197 and 206C subsection 9. In lower deduction discussed under 197, these are the sections that are highlighted. In 206C9, they have only specified clauses covered under 1 and 1C. 1 is specifically sale of 5-6 products, sale of liquor, sale of scrap, sale of mineral and sale of timber, sale of forest produce, sale of tendu leaves. These are all what is covered in 1. 1C talks about parking charges, toll charges, mining charges, lease rental obtained. So that is covered under 1C. Now both 1 and 1C and 197 were specific on what is covered, what is not covered. But TDS bill opens up to all the sections. There is no restriction. Everyone can obtain TDS certificate. Everyone can obtain TDS certificate. Every buyer can obtain TCS certificate. Not every tax collection is covered. Every buyer is covered. So motor vehicle, the wristwatch, all the 10 notified items, they can also apply for lower reduction. In current act provision, they cannot apply. As per the current act, they cannot apply. But as per the new bill, they can apply because they are covered as buyer. So they are not restricted to specific clause, it's opened up. Similarly, in 194J, I have not put the table, but the table number 6, serial number 63 discusses about professional services. It plainly talks about a threshold limit of 50,000. Whereas in the current act, it specifically says 50,000 for professional service, 50,000 for technical service, 50,000 for royalty, 50,000 for not refraining from doing that activity. So it's specific on 4 clauses. But in bill, they have opened up just like that, which means 50,000 is combined 194J. So we can say it is also applicable for managerial remuneration, which was not the case in the act, So now it is specific, 50,000 as a whole. They are not talking about which clause, specific clause, they are not talking about it. So it is, for now it is understood, it is 50,000 as a combined threshold limit. They are only saying 50,000 for A and B. A represents 2% tax rate, B represents 10% tax rate in that particular place where they have referred. So which means they are referring 2% and 10% combined as 50,000. They are not talking about the service nature, professional, technical, royalty. They are not talking about it. So that looks like a change, which might be, if noticed, probably they will change it back again, or we never know whether that was the intention also. So I think it is by mistake they would have left it out. So probably it might undergo change. ESOP is also another section with changes. As far as ESOP is concerned, the procedure is TDS need not be paid immediately. It's a perquisite. It is a perquisite under section 17(2), but TDS need not be paid immediately for perquisites under ESOP. They have not for all ESOPs, for selected ESOPs. What are the selected ESOP? Started companies covered under section 80 IAC. Eligible startup companies covered under 80 IAC, if they are issuing ESOPs, TDS can be paid a little late. What is that little late? 14 days from 3 different periods. So first period is 48 months from the relevant assessment year. Next is you have sold that stocks. Third one is you have quit that company. Within this 3 date, whichever is earlier, on that date, from that date, I have to take 14 days and then remit the payment. This is what is currently in the Act with respect to ESOP. And they have discussed this in 192 itself. In 192 itself, in 1C, they have explained what is the due date. So here in 392, they are not giving you the due date. 392 is the equivalent section for salary. They are not giving you the due date. What are they saying? Pay the tax in accordance with due date referred under 289.3. Now what is 289? 289 equivalent of section 156. Section 156. What is 156? Notice of demand. Moment an assessment is completed, moment a demand is considered, 156 gets raised. So 289 gives you a demand scenario for different situations. So in that they are referring 3 timelines for section 17(1)(d), which is nothing but your ESOP perquisite. Section 140 is nothing but your 80 IAC. Section 140 is nothing but the equivalent of 80 IAC. So for that company, again 3 period, but see the difference. They are calling it 60 months. They are not calling 48 months. They have increased it to 60 months. So for ESOP perquisite, current scenario gives you an extended timeline of 4 years. Bill is giving you 5 years. 1 year extra. This is also a small change, subtle change which is hidden into the bill. Okay, we'll rush on probably 10 minutes. We'll then discuss few things. We'll discuss about TCS in a nutshell. Everything about TCS is discussed in section 394. All the TCS provisions is discussed in 394 in one single table. You don't have 1C, 1D, 1F, 1G, 1H, no such naming. You have simple table, one single table telling you what transaction, what rate is applicable. So I am just giving you a comparison, what is in the bill, what is in the Act, what is the receipt and what is the rate. No change in the rates. As initially in the very first slide we discussed, there is no change in the tax rates or deductions rates, nothing has changed in the bill. So what has changed? Sale of alcoholic was referred in 1.1, now it is in bill 1. We'll take something else like parking lot. It was referred in 1C, 206C, 1C. Now it is referred in bill in 394 table serial number 9. So the bill number that I am calling is actually serial number. Of which section? 394. So 394.1. So the table given under 394.1, serial number 1, 2, 3, 4, 5, 6, 7, 8, 9. So continuous serial number, no confusion on the serial numbers. So this is the order of what is being described. They have also combined 3 and 4. Currently under 206C clause 1, 3 talks about forest produce, sale of timber and other thing from forest produce. Other than forest produce was discussed in 4. But interestingly, rate is common for both, 2%. Then why the difference? Why should I know whether it is forest produce or not when it is common 2%? Bill is now combined. Unnecessarily, why do you get confused? We'll make it common. So it could be forest lease or not forest lease. Whatever it is 2% combined into one single serial number in 3. Scrap, mineral, everything is old. Sale consideration, motor vehicle plus notified goods. We realize that there are 10 notified goods as on date. For all the 10 notified goods, TDS rate is 1% when it is crossing 10 lakhs. Foreign remittance, Finance Act 2025 increased the limit from 7 lakhs to 10 lakhs. So foreign remittance is basically classified into 2 broad categories. One is overseas liberalized remittance scheme, another is foreign tour, overseas tour package. Within that liberalized remittance scheme, there are 4 categories. One is for the purpose of education, money obtained through 80E education, loan eligible under 80E, for which the TCS rate is 0.5%. For any other education or medical, TCS rate is 5%. For anything else, TCS rate is 20%. For anything else, it is 20%. Now, here what they are saying is they have not changed the rate. They have remained the same, whatever was applicable in that liberalized remittance scheme. Be it, of course, 80E is removed right now, so there is 0% for that. So if you are transferring money outside India for education, and that money was not your own money, is something that you have obtained as a loan, which is eligible under 80E, that remittance has no TCS impact, 0%. Other education, any medical, any other payment is subject to TCS. Education and medical at 5%, other remittance at 20%. And this TCS is applicable only when the amount exceeds 10 lakhs. It was 7 lakhs, now 10 lakhs. All three put together, not separately, 10 lakhs each separately, all three put together, moment it crosses 10 lakhs, education plus medical plus others, all three put together, the time the amount crosses 10 lakhs, I need TCS will be collected at the applicable rate, 5 or 20%. For overseas tour package, moment it crosses up to 10 lakhs, it is 5%. Above 10 lakhs, it is 20% for overseas tour package. So this is what is there. This is continues to applicable with regarding TCS. Not much changes in advance tax, but for couple of discussion. First thing, 207 talks about applicability of advance tax, whereas 403 refers in a simple manner saying current income of the taxpayer should be calculated. Tax should be calculated on current. So it's just rephrasing the word. They have introduced the term called current income. But what has main thing what has changed is introduction of a formula. Currently the law is plain with reading. They are saying while computing liability for advance tax or income tax calculated A or B or C, reduced by the aforesaid amount. So whatever tax I am calculating should be reduced by amount deductible or amount collectible. This is what is given in 209. So this was a theory, a legal reference. Now they have made it as a formula. They are calling it as A is equal to B minus C. What is B? Total tax, calculated tax. What is C? Tax deductible, tax collectible. So now they have referred it as a formula. I told you that they have also introduced several formulas, close to 46 formulas across the bill. So TDS chapter has one formula, which is about this formula where it helps you in calculating advance tax. There's nothing new about it. Same thing what we have been doing day in and day out, just that they have introduced in the formula manner, just the rephrase structure. And they have defined what is A, B and C. Advance tax, this is the mapping as I told you, which we already saw. So I think this is how broadly chapter 19 is structured in a way how it flows. So I basically wanted to share some info on how this bill got evolved, how this chapter 19 got structured, how it is reformed from the current provision to the existing provision through practical reading of different sections and highlighting the recent updates. So this was the intention of this 3-hour session. So I have covered my area, so I want some time for you to discuss any specific area about this and then we can wind up. Anything about this transformation bill that we were talking about? I rushed through in the last 10 minutes so that thinking that you'll ask me something. So as I told you, this 393 is overall section for TDS, 394 is the overall section for TCS. So that's what summarizes all of this. 393, as I told you, is structured into tables in specific manner. 1 resident, 2 non-resident, 3 payment to any person, and then you have 4 which talks about exception. So everything is, this is what is how it is structured. So and we also saw how it got, it flows from the act to the bill about how 194 IB is discussed in various different sections, or how 194C is discussed. And we also discussed about some minor changes in the bill about your ESOP, your 194J where the threshold limit is not there, and then also this 197 relaxation where it is opened up for all the sections. So if you have something specific in this area to discuss or ask me anything, yes sir. Yes, sir. That is removed from Finance Act 2025. So from 1st April 2025, it is 206C clause 1H. So 1H was first introduced for sale of goods, where whenever you are selling goods more than 50 lakhs, provided you are an eligible seller with a turnover of more than 10 crores. So if I am selling to any one person more than 50 lakhs, I must collect TCS on GST because it is on collection. It is sales amount plus GST. I should collect 0.1% on the amount exceeding 50 lakhs, only on the amount exceeding 50 lakhs. Then immediate next year, very immediate next year, 194Q was introduced, where 194Q said it is on purchase of goods for eligible buyers. So who's an eligible buyer? The one with more than 10 crore turnover is an eligible buyer, and they will have to deduct if they are buying more than 50 lakhs. Now both of this contradicts. So the provision said 194Q prevails over 206C 1H. So whenever 194Q is applicable, ignore 206C 1H. But if there is any miscommunication, sometimes what was happening was seller was collecting 206C 1H, buyer was deducting 194Q. So this was happening. And then in the Finance Act 2025, what they said was, let's leave this. 206C 1H was completely scrapped, saying that from 1st April 2025, no more TCS on sale of goods covered under 1H. Instead, what they have done was they have introduced notified goods in 206C 1F. So where they say that when your motor vehicle is sold, not only your motor vehicle, they have included 10 notified goods. So that is what that wristwatch, paint, arts work, all that comes in picture. Even your home theater system, all that is covered. So if you are buying more than 10 lakhs, TCS will be collected. So it is now restricted only to notified goods. Anything else? That's what. See, basically we have to see whether that income was generated from the sport activity or that relevant activity from India. If that activity has happened in India, the moment wherever the money is settled, it becomes a deemed to accrue or arise in India according to that section, and it becomes taxable. Now, how will department get hold of it? Probably only by a number of some foreigners coming here and going, not on tourist visa, and they might check. So far, the customs and the income tax is not so interlinked. They're slowly starting about digital immigration. Moment this digital immigration comes into place, government will immediately have a track of who all went when and when have they come in. So they might have an idea on not on tourist visa. So yeah. Yeah. So currently we don't have a very strong hold of catching this, but the provision is for them to deduct. Even if they are a non-resident to non-resident also, it is applicable. But of course, department catching hold is only through the identifying through the exit in, out and activity that is being carried out. So probably most of them, sometimes they do a spot verification as a survey. They go and check these franchisee owners. They go and check as a franchisee owners. Survey doesn't get informed in the public media much. So there might be a small short survey to check how it has been settled related to that place, because it's a huge activity. So such common activity may be monitored through, once they find out one area, then they'll probably expand it to others. Otherwise, there is no common practice for now. And that sports person need not play sports, even writing newspaper articles, even acting in advertisements, everything is covered for that sports person. So it doesn't matter what that sports person was doing. So all these activities are covered for him. In fact, in 194J for professional notification, it not only says sports person, it also says sports columnist. So anyone who is writing a sports article in a newspaper is a professional according to 194J. They cannot apply 44 ADA. because they are not a profession covered under 44 ADA, but they are a profession covered under 194J. So TDS should be deducted at 10%. So, so that will remain because they are notified professionals fund 194J. So anything else? Okay. So hope there was some value addition to what I took based on what it is there. So thank you for the session. Thanks.
So on behalf of SASC of ICA, I thank you CA Muthupalaniappan sir for a session on new income tax bills on TDS, TCS and advance tax provisions along with the very interactive sessions. Thank you all. Enjoy your Saturday evening. Thank you.